All right, so we will be conducting two sessions today. The first session will be conducted by Mr. Benny Lee. Over there, he's the chief market strategist from EquitiesTracker. So he'll be talking about the latest tool that we just launched last Monday on the 9th, the Singapore Stock Selected 2. And then the second session will be conducted by Mr. Paul Chew. Yeah, he's the head of research from Philip Securities Research, coming all the way from Singapore. Oh. And he'll be talking about the Singapore market outlook today. So the topic that we cover today will be the review of 2022 markets, the highs and lows. And then we will talk about the top stock picks for this coming year. And then we'll talk about the rate hike peaking in 2023, and we will also explain why is a recession inevitable. And last but not least, by the end of the session, you will understand how you can position your portfolio in 2023 and beyond. And after that, we will carry on with lunch before the session ends. So here's the speaker's profile. Let me introduce them to you. Mr. Paul Chew, he has 20 years of experience as a fund manager, and he used to manage multiple funds and mandates, including capital guarantee, dividend income, renewable energy, and so on. And he is also graduated from Monash University, and he had completed both his Chartered Financial Analyst and Australian CPA program. Where Mr. Benny Lee here, he is a certified CPE trainer by the Securities Commission of Malaysia, and he specializes in the financial market, technical analysis and trading methodologies. Well, he actually provides investor education in Malaysia, Singapore, Thailand, Vietnam, and Hong Kong for the past 9 years. He has been also trading in the Malaysian and Singapore equity and future markets for the past 10 years. So without further ado, I'll pass the mic to Mr. Benny Lee for his talk. Thank you.
Thank you, Zui. Yeah, I'm just using this. Good morning, everyone. First of all, thank you so much for joining us this morning. I know Chinese New Year is just next week, so you're probably going to go for shopping at the end of the day. But thank you so much for spending your time here. I hope that today's session will be beneficial for you guys. Probably on the second session, Paul is around now because he's the only one who can actually give stock their stock picks, right? But what I'm going to share with you is basically a tool that EquitiesTracker developed for the Singapore market, right? For those, I think we have seen some of our members here as well. You have probably used our system, but this software is basically available for the public for free, right? So that means you can have access to this. Okay, so all you need to do is to go to sg.equitiestracker.com, right? Even you can do it on your mobile if you have, right? But the mobile experience will not be as good as using a laptop, but you can still do it, right? So the idea of this website, I know there are quite a number of websites that you can go to. We want to make it as simple as possible for everyone to use, and therefore it's a very simple website or tool for you to use. Okay. So basically, the tool that we want to give here, although we call it the stock selector, is to give you investing and trading ideas. All right. It's not a buy or sell call, but to give you ideas so that you can explore those stocks further or the companies further. And one of the things that we have built in quite comprehensively is the REITs tool. You know, Singapore REITs, right? Real Estate Investment Trust. Okay, so if you guys are interested to invest in Singapore for REITs, then I'll show you later what information that you can get, right? To give you an idea what the REITs are all about. All right. So I'm just going to stand here, if you don't mind. If you have any questions at all, you can just raise your hands. We will pass you the mic because there'll be people online as well who are joining. And those who are online, you can also ask the questions. Just type it in. Our colleague will basically represent you and ask the questions. All right. So at any point of time, you have any questions, just raise your hands. Yeah. We'll pass you the mic first, then only you speak. Right. Because then also the online guys can hear. All right. Okay. So I'm going to go to the website right now. Like I said, you can, if you want to follow, you can on your phone. But it will not be exactly the same as the screen here, right? Because it's a mobile version, right? So it's a little bit different. But you can type it in. Are we in already? Okay. So on the website, you'll be able to see this first banner here. This Singapore Market Campus is a Facebook group, right? So all of this, if you want to have discussions, if you want to ask questions and so on about the Singapore market, you can specifically come here. But you must have a Facebook, of course, because this is a group, right? So you can just join, and then you have a few people who contribute to ideas and all that in this group as well. Right? So it's a communication tool, all right, on the Facebook group. So you can join this. Again, there's no fees involved here. Okay, and then if you browse down, if you look at the top, there are stocks and REITs guru. So we separate stocks with REITs because the way we evaluate stocks and REITs are totally different. All right, and Malaysians, I think one of the attractions in Singapore are the REITs. There, they are more diversified. They are, they also like have international or foreign properties, right? Now, Malaysian REITs is pretty much local, and they are more diversified. They also have data centers and all that, right? Shipping and all, and so on and so forth. So there are more choices in Singapore. Okay, so I'll just go through with you the stocks part and REITs. So remember, this is there's no filter here. That means you cannot put your criteria for filters and all that. Because this is just the first stage that we are doing this, because we want to make it as easy as possible for everyone, right? So if you're looking for ideas, this is where it is. Okay, and I'll show you how to find these ideas. Okay, now you can browse down a little bit. You can see this market analytics, these buttons here, right? You can see it on your mobile, but probably it's small. But these are the shortcuts, all right? If you want to click. So I'll go through with you as time allows, as much as possible, all these features to give you an idea what it's all about, right? So there are, for stocks, remember there's stocks and REITs, For stocks, there are fundamental ideas. There's also technical ideas. Technical ideas is basically using charts, which I explained to you, right? How the ideas derive from. It is all there, it's all transparent. We also put the criteria, right, for how we filter out these stocks. Okay? Now, so you can browse through here if you want, if you already know, but if you don't understand, what is all this, right? Rising stars, it's better if you can go to this part here, explore stocks. All right? So when you click explore stocks, you see their stock selector here, trading ideas, which means these are technical, these are short-term ideas, all right, based on charts. Okay? And if you go down a little bit bottom, you'll see investing ideas. This is based on fundamentals. Everyone okay so far? All right. Now, I'm just going to go through the investing ideas first. All right. Now, I'm not sure about you guys. How many of you are more trader than investor here? Anyone? Maybe online, you can also type, are you a trader or are you an investor? Just type it online so we can get know you. How many of you are trading? That means you're very short term. Huh? Sorry? Both also can, right? I mean, you can trade short term if you want to. You may have a long-term investment portfolio also. Okay, how do you differentiate? Traders normally don't have a portfolio one, right? You buy, you sell, you buy, you sell, you buy, you sell. There's no long term. But very short term, you always change, right? So how many times do you trade in a year? Or every day, Oh, so you have a portfolio. I would not call it really a portfolio. It's a watch list that stock that you trade, right? Okay. Okay. Yeah. So you manage it more actively, We have a word for it. We call it active investor. Because normally investors is long term. You buy, you put the portfolio there, you leave it for years, right? But normally we'll do also like adjustments, because we look at quarterly reports and all that. We do adjustments and all that, right? But portfolio objective is normally long term, right? But you are active investor. That means you manage the stocks in that portfolio, Okay, so investing ideas is basically based on fundamentals, right? So I'm just going to share with you a bit here. So that means so the names here say itself, there's also an explanation there, right? Like for example, if you look at rising stars, so this is the condition. This has grown their net profits for the last 3 to 5 years. That means these companies are companies that's grown in its net profits over the years, 3 to 5 years. So if you want to look for growth companies, rising stars. All right. Now, dividend kings, They got profits, they pay consistent dividends, and they have positive operating cash flow at least for the past 5 years. That means you know that for there's a high probability that these companies can continue to pay dividends, right? Then your job is to do and find out what are the dividend yields, right? Then you can invest. But these are again all ideas. But what you can do is you can continue to do your own due diligence. You have to do your own research proper, go deeper a little bit before you invest in these companies, right? Moat defenders, if you are looking for companies that have high margins, that means their profit against their revenue, the margin is high. Okay, they make, let's say, 100 million revenue for income, 100 million, and they make at least 80 million. All right, 20%, that means they make, the cost is 80 million, they make 20 million. Okay, so they are, we call it a moat, economic moat, because their margins are high. So these are all companies that has high profit margins. Okay. Cash hoarders are company that has a lot of cash. They're hoarding cash lah. Okay, it may be a good thing, it may not be a good thing also, right? Because sometimes company hold too much cash but not growing also for what, right? But if you want to look for company that have a lot of cash, then it's here. Okay. Continuous heroes. These are company that has gone through a very good hot streak, long term lah, right? So this one has uninterrupted profits. It means continue to have profits over the past 10 years, continue to pay dividends over the past 10 years, and continue to have positive operating cash flow in the past 10 years. Okay, this one, for who are familiar with us, this is like our investment grade stocks, right? They are long-term in nature. They are very consistent over the past 10 years. Okay, so we have basically 5 of them, 5 ideas here. Okay, so when you click on one of them, let's say rising stars, these are growth companies. All right, growth companies. So you have a list here. Okay, now on this list, so you can look at the growth over the past 3 years or over the past 5 years. You look at the top tab here, right? There's 3 years, 5 years. So yeah, you want to look longer term, you can go 5 years now. But of course, if you look at this one, you probably have a smaller list, right? Because it's very consistent. So this is basically the stocks that you can see here. And you can also sort them by price, or let's say even market cap. This column headers here, you can actually click and to sort it one, right? Now this is a very small market cap, this is like $10 million company edition, right? So if I click this again, this one is 95 billion. Okay, IX Biopharma. So you can click whatever that you want. You can click by stock name if you want to. So this one here we have, let's see how many companies. Okay, a total of 121 companies. They are rising stars in Singapore. That means they have continuous growth in its financials. All right. I'm just going to take a look at this. Let's go back to page number 1. Okay, let's take a look at IX Biopharma now. I'm not familiar with the Singapore market, so I'm just representing this based on the financials only. All right. If you want more dive deeper into financials, then you can ask Paul here. He has a team of research guys to do all this, right? So you can look at this. The subsectors are all there. We have so IX Biopharma is basically a pharmaceutical company. We have a financial tech here. You see this one. This is the latest profits based on the financial year. For this, it's actually 2021. All right, because 2022 hasn't come out yet. All right, when we go and dive deeper later, we'll show you what are the dates, the last dates, the last financials that we're looking at. Okay, but you can also look at the latest quarterly if you want to. Okay, later I'll show you. So let's take a look at Biopharma. So you know that the last year net profit has actually gone down. But just going to click this. When you click the company, all right, it will give you the basic information, what it's all about. Where it's high and low, that means the price now, you look at the meter there, it's at this 1 year low, right? This is a stock price. You can play around with this if you want to. So you see our trend is going down, right? And then you can look at their financials. So there are quite a number of things you can do here, the information that you can get. So when you click on the financials, this is basically a summary of their, of course, financial statements. You look at profit and loss, you look at the cash flow statement, you look at the balance sheet, right? So it's all there. Okay, so this is profit and loss, 10-year profit and loss. So this company has been making losses. all right? And you have to look at this way, okay? Now, why is it still a rising star, but they're not making money? Yeah? Their losses are getting smaller. All right, so we are looking at that aspect, all right? So remember, I said these are, again, the filter is based on financials. You have to dive deeper a little bit, right, to see whether this company is profitable or not. So some companies may not be profitable, but their losses are getting smaller. Yeah? So maybe this is not a good company, right? And you have to look at the other financials as well. Okay, so if you look at the 10-year cash flow, their operating profits has been negative, suddenly positive operating cash flow. All right, so you have to find the story behind. Okay, numbers are numbers, right? What we teach in EquitiesTracker is also the story behind the numbers. What happened? This may be a rising star, right? We do not know, okay? But of course, you have to look at their investing activities, how much they're investing, and so on and so forth. This is their cash. So this is a cash flow statement, right? And you can look at their balance sheet if you want to. I'm not going to go through all this, all right? But just to tell you that this information are available. Okay? These are yearly financials. So we put it on a graph as well to show you their net profit, revenue, and the operating cash flow on the chart, so you can see the flow. So if you look at, let's say, revenue, I can always click on this button here to disable. I don't want to see net profit, for example. If I don't want to see OCF, this is the revenue. Okay, you can see the growth that you see. Why is the rising star that is here? Because 2021, 2022, there's a growth, right? They were not profitable for a very long time, and then suddenly last year they went up. All right, that's where we see the financials also. You can see that their net profit has actually gone down. Gone up also. Okay, but still negative. Gone up means compared to the previous year performance. So you can look at okay, the net profit against the revenue. So if you look at revenue and the net profit, this is their margin, right? Okay, so if they are making 7 million profit, I can't see so near. 7 million profit, but their net profit is negative. Right? This is the zero line, so they have been not making profits, but you can see the growth in profits. Growth means better profits year on year. Okay, but it's still negative, right? They're still not making money yet. Okay, and then you can look at the cash also if you want. So we put three of them together. The cash has been going up as well. Can you see that? Okay, so remember this one is, this filter is basically to give you an idea based on their financial performance. Okay, so rising stars are those who are probably, they can be profitable, but their profits get better, or they can be not profitable, but their not profit or their losses get smaller. All right, turn into positive. You get it? Okay. So I'm going to go back. Then you can look at the rest of them. So the information that you get is basically quite the same for all the stocks. You have the 10-year financials, all right? Like Samudra Shipping, for example, right? So you can look at this, you can look at one glance when you go to financials. You can see that it's also rising, right? They've been going down, they've been slowing down from 2012 to 2017. Then here it went up a little bit, 2018, 19, 20, you know, COVID-19, right? Okay, and now they're starting to go back up again. And their revenue here is the highest in the past 10 years after the recovery from COVID, right? And you can see the net profit is going up as well. Okay, so this filter, when you look at rising stars, is trying to find this kind of companies, right? They were not doing well previously, it was going down, but now starting to move up. So it's called a rising star. Okay. Then you can look at more details. So again, I'm not going to go through all these details. Here is where you do your own research. Then you can look at the quarterlies. So you look at this one, the last financial day was 2021 December, right? On the right-hand side, right? 2021 December. So we're probably going to get this only in the next 2 or 3 months before numbers are updated. Okay, but when you go to quarterly, you get the quarterly performance. Okay, this is the latest at the bottom. This is the previous one. So you can see their profits and their revenue has actually increased over the past, this is 4 quarters, 5 quarters. Okay, so we show 5 quarters, latest 5 quarters. So they've been doing very well, right, in the last quarter. So this one will show you the performance. Okay, so the last one was in June 2022. Of course, when we get their year-end financial statement, it's going to come with the annual financial statement as well. Okay, so you can see the turnover here is actually quite, for the past 2 quarters, has jumped quite a lot. Right? I think business activities are getting back to normal, right, after the COVID pandemic. You can see here this quarter in June, 2020 was 2 years ago. So this one only released results every half year, not quarterly basis. Right? So H1, H2 is first half, second half, first half, second half. Right? So if you compare the first half of 2021 and compared to now, from 209 million to 476 million. Increased quite significantly, and if you compare to the previous year, it's also increased quite significantly. So there's really strong growth in this company now. Okay. So this is quarterly, so you just show the quarterly. Here is basically for you to do a comparison against the company, for the company against their competitors. All right, so we have Samudra Shipping, we have Costco Shipping. So this should give you an idea. For example, that PE here, these are historical PEs, we don't do forwards. All right, that means this PE here is based on the 2021 earnings. Okay, the last financial statement we get was 2021. So this will get updated again in the next few months. So the PE is only 1.5. All right, it's low. And if you compare to, let's say, Costco Shipping, PE here is 17.6. Okay, so this to give you an idea, comparison against the industry. First Ship Lease is 7.9, and then we have Courage Investment here, PE only 1. So, so if you look at Samudra Shipping, actually the PE is quite low compared to its peers. Now again, this is all this information is here, but you have to make your own decisions, right? Whether you'll be investing in this stock. So it's a good tool for you to compare its peers in that industry. All right, and in EquitiesTracker, we have actually divided into subcategories. You can see here, because if you're familiar with Malaysian market, we always have like retail index, right? But there's so many retail. I mean, shopping complex can be retail. People selling petrol also can be retail. People selling like Nestle products, consumer products also retail. So it's a lot. Okay, so we actually divided into subsectors. So you get a more accurate competition or comparison. All right. So like for those who are using our software, you will know it's the same subsectors. Okay. So you can do comparison here. Then you can look at their major shareholders, right? Who they are. There's an Abing who holds 393%. Ang Abing. You can look at also their historical capital, if there's any corporate exercises and all that, for dividends or even changes in its capital, bonus, rights issue and all that. It's all here as well. Okay, and then you can see their dividend. We call this a heat map, where you see you can almost basically find out the consistency on the dividends that they pay, and you see that most of the time they pay dividends sometime in April, right? So at one point view, you know that you pay around in April. Okay, you can see here as well, this is the X date and their pay date for the dividends. And you can see sometimes they pay in June and July, because for the past few years, because of COVID, all the financial statements were delayed a little bit. So that's why but normally, but averagely, most of the time they pay in April. Announcement in April, not payment, announcement. Okay. Then you can see who the directors are. Now, of course, we don't have any link to the directors and what they own and all that. We haven't done that yet, right? But these are basically the directors of the companies. Okay, so we have shareholders, we have directors, we have capital dividend info. You can do comparison. We have the yearly financials and quarterly financials. So the information are all there for you to use. Anyone have any questions so far or online? Yes. Can you get a mic there? Hold on, can you give your mic?
Yeah. Your dividend heat map you were talking about is over what period? 10 years or the most recent 3 years or what?
This one will give you the, I think about 10.
The heat map.
10 years.
10 years, okay.
Yeah.
5 little neat groupings I saw just now, is that a segmentation or is that a non-mutually exclusive categorization?
Okay, we go to the main sectors and then we just divide them to sub-sectors.
No, no, no. I'm talking
you're talking
about
about
you know, those, your segments, the 5 neat little
Oh,
segments that you
okay.
have way at the
You mean
start when you,
the filters lah? is it?
yes, yes. So are they a segmentation or are they, you know, just a loose categorization?
Yeah, it's all on all stocks lah. It's loose.
So
it's not-
meaning they are not mutually exclusive. You
No.
can find one company in one, you can, that same company might appear in the
Yes.
other. Okay.
Yes, it may. It may. Okay, we may see that company in, let's say, dividend kings. If they've been able to pay dividends consistency, they are there also.
Okay.
Yeah.
So it's not a segmentation.
No, it's not segmentation.
All right.
Yeah.
One more question. You said that those are investment ideas, not for trading, right?
Yeah.
So they are based on fundamentals. I think you mentioned that too. So since they are based on fundamentals, are there also any other pre-filters that you put in before they are being selected? Like for example, they must meet certain criteria.
No. This
No.
is the
so
criteria.
just based on growth in the recent 3 years or something. Just
Yeah. So it's the general one.
okay.
We don't really go and filter out deeper lah. So that's
Okay.
where probably the next stage now, because this is the first card. So you look at the criteria, it will be at the bottom. This is exactly the criteria.
So as what you state,
Here, yes.
nothing more.
Nothing more.
Okay. Thank you.
Nothing more. Okay. So it's transparent over here lah. The reason why we don't know how to filter down deeper, because that again depends on the investor themselves, what they're looking for, right? So this is just a general filter for you guys to work on later on, right?
Oh, one other question.
Yeah.
You have shown us Singapore. Is this also available for Malaysian stocks?
Singapore is free. Malaysian stocks,
How much is it?
it's only like 200 ringgit a month.
Only.
Yeah. But you will have more stuff in. You can just ask any of our guys here.
Okay. Right.
Because we have the monthly meetings, we have engagements, we have our research stuff and all that, which is included in that package lah.
So how long will this Singapore one be free?
For now, yes, it's free. So we do not know yet. We're just hoping for Singapore for me to buy it lah. So, but now it's for free lah. Yeah, you have a question there?
You say free means you need the password to log in?
No password, just go in and use.
Just type the address.
You can use your phone now and try also.
Okay.
Yeah. So no login, no nothing else. It's just open for public at the moment. All right. Any more questions? Okay, so thank you for the questions. Good questions, huh? But again, criteria, like I say, is all down there, it's all open. Huh? I'm just going to go back here again. So stock selector. Okay, so dividend kings, right? Again, this one, if you look at the strategy, so this is a criteria, right? Untrapped net profits, dividends are positive for the past 5 years. That means continuously making profits. They have been paying dividends for the past 5 years, and also they have a positive operating cash flow for the past 5 years. That's the only criteria. Okay, and this is sorted by dividend yield, and this excluding REITs. Yeah. They can be. So that's why you have to go and dive deeper. Huh? Okay, but this will give you an idea lah. So again, this whole idea about the website is to give you ideas, but it's not a buy and sell. It's not refined yet. All right. So you have to refine it further by your own analysis. Okay. So at least, you know, if let's say we have a seminar or whatever, you know, you can always ask the analyst to give you more information, right? Oh, I see this. Okay, Riverstone, right? Oh, you know Riverstone story, huh? Okay. So you have to be careful with some of these companies, but in Malaysia, you have to be careful with most of companies. Okay, so let's look at Ban Leong Technologies, computer hardware. So same thing, you get the same information here, right? So this one, dividends, so you can look at their financials. Okay, you can see their dividends. Sorry. The earnings per share is here. Net profit and loss to shareholders. Hey, hold on. Okay, so if you look at this particular company, if you look at their uh, uh, profit and loss at the top. So this one is, it depends on how you look at it, whether it's short term or long term, right? From 10 years ago, they're making 113 million, and now they're making 225 million over the past 10 years. You compare 5 years, but the growth has been quite steady. The operating profits have been quite steady as well. This is a tech company, right? Yeah. Okay, and their share prices are going down. So this may be an opportunity of value because the financials are actually improving, but the share prices have been going down. Okay, you can also look at longer term because if you are quite familiar with charting tool, then you can play around with it lah. Okay, so long term it's actually still going up lah, right? But it's just that it's pulling back in the past few months. Okay. Now I'm not gonna. I've already shown you all the other stuff, but again, you can just play around with it. I'm just going to go through the rest of it lah. So basically, dividend kings are companies that have paid dividends consistently lah, right, over the past 5 years, and they also have the profit to back it up, and they also have the cash to back it up. All right. And then you go to mode defenders. These are companies that has high margins. So if I look at their financials, okay, there are times with the high margins, there are time here, this is crazy lah, right? The net profit can go higher than revenue. I'm not sure whether this is the correct data or not, but there may be some disposal, we don't know, right? Properties, it could be. So again, you need to find the context, all right? See, why got this jump here? And net profit can go higher than revenue one, yeah, yeah. Okay. So all the information are the same, right? All the information for you to work with are the same. Because I still need some time to go and show you the REITs part, yeah, and the investing ideas, trading ideas. Okay, go back. So more defenders, we have cash holders. I think I'm not going to go through this. You can guess because the criteria are all there. So make sure when you click, for example, cash holders, you go at the bottom, then you should see the criteria. Okay, so the criteria is exactly as it is. Okay, there's no additional. Okay. All right, so any questions before I move on to this part here, the technical stuff? Okay, okay. Later we'll try to, maybe the second version or whatsoever, we want to cross-link between the financials and also technicals. So that, I think you mentioned earlier, whether there's mutual exclusive, is whether that party is just mutual exclusive, or you can actually have a few categories that it belongs to, right, of filters. So we link them up later on. I think it's a good idea. But, okay, so this one is based on charts. Again, there's also criteria. So this is basic write-up, right? So what are tradable stocks, right? We always have this debate, actually, with even with some of our partners. So that means the stocks that are not in this list are not tradable one. Okay, tradable means if the stock has sufficient liquidity, enough volume, and also volatility. So if you want to look at the criteria, right, it's here lah. Okay, so the closing price is above 20 cents. So any stocks that's below 20 cents will not be in this list. Average volume is 500,000. Average daily volume. Average trading value is $600,000 in the past 1 year. Right, this is average. It can be higher, it can be lower. Okay, and average weekly volatility is more than 4%. That means every week this price either goes up or goes down 4%. We want price that move. All right. Singapore is not as volatile as the Malaysian market. Okay, so you see a very short list. In Malaysia, I actually put a criteria above 8%. Okay, because you want to find really good ones, right? But if I put 8% for Singapore, you maybe get 1 or 2 stocks only. That is really volatile. So you get all these stocks. So they are about here, and this list here don't need to be updated. All of the others are updated on a daily basis. Okay, but this tradable stocks here is updated on every 2 weeks. Okay, because this list don't change a lot one every time, because looking at averages, right? So I go and look at number 2. So there are a total of 20 counters that met that criteria I just mentioned. Okay, 500,000 shares being traded daily, averagely. Okay, and also has a 4% weekly movement. Okay, so if I'm looking for trading ideas in Singapore, then I want to focus on these counters lah, because these are the counters that move for traders. All right, if the counter don't even move 1 or 2% a week, then why do I bother? Okay, so like, okay, just when you click on the counter, you get the same information that we received earlier. Okay, so this is a company, and you can see also lah, when we have nice volume and volatility, you see the price chart also very nice one. Okay, it doesn't have like gaps and all that, right? Low liquidity stocks, you see a lot of gaps. Okay, and then for if you are a trader, you probably depend on charts, right? And if you use charts on a counter that has no volume, you get distorted indicators. So it's good to have volume as a criteria, okay, and also movement. Then you get a nicer chart, and your analysis will be better using technical analysis. All right. So that's tradable stock. Like I said, this is just the criteria only. There's no like overbought, oversold. That will go to the second part. All right. And then if you go to rock bottoms, okay, so if you want to look for companies that has gone down, right, more than 30%, okay, the criteria is basically the price has dropped at least 30% from the 3-year high. The highest in the past 3 years, so that you look at the high for the past 3 years, so it has fallen from that level at least 30%. Now this is sorted by the biggest percentage drop lah. So same like Malaysian market, Top Glove is here. Okay, so that means from the 3-year high, which 3 years ago, which is a historical high, right? The price has fallen about 92% already. Okay, Malaysian is the same. All right. Then we have even this real estate investment trust for First Street has also fallen quite a lot. I don't know what's happening here, but yeah, from the 3-year high, it's actually gone down quite a lot. For a REIT, right? Then we have the rest lah. Mostly technology. We have some other companies here. So if you want to look at the number of companies in Singapore that has gone down more than 30%, then you can go to the last page here. There's 75 of them. Okay. If you run on our site for Malaysian market, guess how many? It has fallen more than 30% in the past 3 years. The highest from the past 3 years. 300 over. Yeah, that one no need to say lah. That one, right? Top Gloves somehow. But there are 300 over companies in Bursa Malaysia that has actually gone more than 30% lower. So this will only show counters that have dropped more than 30% from the high lah. Okay, the others will not be shown in this list. Okay, so the reason why it's called rock bottom is this: if you are looking for value, then you want to look for these counters. But remember, price will also tell you the company about the company, so you have to do your own due diligence. Okay, so that's rock bottoms. Now, in this part, we have basically 2 parts actually. There's uptrend support. Okay, it's opportunities or alerts. Okay, we cannot put there buy or sell because we're not allowed to. All right. So opportunities means there's opportunities to buy lah. Okay, buying is up to you. It's not from us. Okay, we are just giving you ideas. And then we have downtrend. So uptrend and also downtrend opportunities. 2. Yeah, I'll show you the criteria. The criteria is all there lah. And then alerts in an uptrend, alerts in a downtrend also. Okay. So I'll give you an idea, and this is also updated on a daily basis based on the daily price movement. Okay, let's take a look at, okay, I'll look for stocks that are in an uptrend. Okay, but where do you buy in an uptrend, right? The question is, do you buy when the price goes in an uptrend and buying at the high? You don't want. Okay, so the idea here is that this is actually we call it buy on dips in an uptrend. Okay, you buy when the stock pull back from the uptrend, not when it's high. So that's the idea. Okay, stocks are going in uptrend, but they have come down, they have pulled back. Okay, so I'll show you some examples if they are. Okay, so this one is based on short term, medium term, long term. So we use moving average as a guide. Okay, so 30-day for short term. This is technical. For those who don't technical, then this will be beneficial for you guys. But for others, it's short term, medium term, long term. So that means this company, Yanlot, okay, is in an uptrend in the short term. That means it's above the 30-day moving average. I do not know about 90 or 200-day, but it's above the 30-day moving average, right? And the price has pulled back to the moving average. Okay, price is near the increasing moving average. So I'll just show you an example. So I go to this particular chart. So you just click there, it'll show you the chart, right? Okay, so these are indicators. These are the default ones we put in, but of course you can always change those indicators. So if you look at the blue line here, right, that's the 30-day average. Okay, the red line is the 200-day average, the long-term one. Okay, so you see that's the difference, right? The long term is still down. Okay, but the short term now is starting to go up. Okay, and when it's up, we do not want to buy the high, isn't it? Okay, so now that the price has pulled back to the average, so now it's at the average price for the short term. So question is whether you can buy here or not. Again, you have to do your own additional analysis. Okay, but it's giving you some ideas. That means we are looking for stocks that has gone into an uptrend and has pulled back to the average. Everyone got the idea? So that's the filter. Okay, so this is based on the 30-day average. If I'm going to go back, okay, 90-day average, that means no stocks that are long-term yet, medium-term yet, has not pulled back yet, all right? But if you go and, let's say you come in again tomorrow, this may change, because the price may go down to that level. So this one is updated on a daily basis. Now the fundamentals one will only get updated on a quarterly basis, all right? Because fundamentals you only get, like some companies in Singapore, they only do half yearly, so only half year, okay? But for technical, it's every day. Okay. The only thing that you get changes on the fundamental side is the PE ratios or dividend yields, because that's based on the current price. Anything that's got to do with price will be updated. Okay. The rest of them will not, okay, only on a quarterly basis. So long term, medium term don't have, long term also not much. Okay. I'm going to come back here. So that stocks in an uptrend in the short term, medium term, or long term. Now we can also look for downtrend support opportunities. So only one counter here, right? And we also put a checklist here whether this stock is tradable. Remember the tradable criteria that I mentioned? That means if it does not have the tick here, that means the price do not move averagely 4%. It does not have the volume, consistent volume, all right? But let's show an example. So what do I mean by short-term opportunities? Okay, so you look at the charts again. This 30-day, right? So you can see that the price has gone down, correct? The price has gone down. And what we are looking for is when the price is going down, is when the price is being oversold. Okay, again, if you guys know about technical, then you know lah, right? Oversold means here we use RSI as the oversold indicator. That means price is in a downtrend, but it's really, really low. Okay, why it's low is because if you compare with the average price, it has gone way low below its average. So technically, we may expect a rebound. Okay, so uptrend, I showed you earlier, price is above average, right? And the price has pulled back to the average. This one here, downtrend, but price has gone way below the average. And when we have an oversold situation, like this part over here, when we have oversold, this is where we're going to expect the rebound. All right, at least to the moving average lah. Okay, so again, ideas, you have to refine it further, but we're just putting it there so that you give an idea, right? Based on the price against the moving average. Okay, go back here. Okay, so uptrend, support, downtrend, opportunities. Remember, that means there are basically opportunities to buy. And we said opportunities is because we make money only one side, right? Because if we can short, then it can be an opportunity to go short also. But this we are talking about stocks only. Okay. Now, alerts, what do we mean by alerts? So this one, price is an uptrend, okay, but has already gone up way above the average. overbought. All right, this is the opposite of oversold. So we have a few companies here. So it's good to also gauge this, right? You open and see, wow, why many companies are overbought? That means all gone up very high already. Okay, if very little means okay lah, not many lah. Because sometimes this list can go very long. Man. Okay, that means you know that all companies are going up already. Okay, and then sometimes you see, so this one will change. Sometimes you see, wow, all the companies are oversold. Okay, so this will give you an idea also how many companies are actually overbought or oversold in the Singapore market. Okay, so I look at, let's say, okay, Genting Singapore lah. Okay, why is this in this list? Remember, this is a uptrend overbought, right? That means it's quite high already. So I'm just going to show you why is it overbought. That means if I'm a trader, I will not buy at this price lah. Okay, can you see why it's overbought? Price is an uptrend, yes. Okay, it's an uptrend, but it has gone way above the average. Okay, so if I want to look for it to become an opportunity in an uptrend, I wait for the price to come down to the moving average. It's near the moving average. Then that will create an opportunity. And then this Genting will be in that stock list earlier. Okay, the uptrend support opportunity. But for now, it's high. Okay, so the filters is basically to tell you, again, this is technical. So it's basically the correlation between the current price and the average price in the short, medium, and long term. Okay, so short term is defined by the 30-day average. So long term is way above the 200-day also lah. All right. So Genting has made a comeback lah. In Malaysia also, right? But if you ask me, can buy now? Technically, I will not lah, because it's high. Right? So I want to wait for it to pull back a little bit first. Okay, so this is uptrend alerts. Now there's also downtrend alerts. The last one. Okay, so what does it mean is that price has gone to very oversold and then has already rebounded. Okay. Again, if you're not technically inclined, then this may be a bit too cheap for you guys, but I'm just going to show you, right? So price has already, can you see the price has already, this was the low, and the price has already rebounded. And it has rebounded to the average. So that's why it gives you an alert, right? Of course, I want to buy when it's here, right? Okay. So this one here, maybe 4 days ago, it was on the downtrend or downtrend oversold opportunity. Okay, if you look at 5 days ago, the stock may be there at least, but now it has already gone up. So that's why it comes an alert already. Okay? Okay, any questions from here? Okay? So just explore, because it's available for everyone, right? Just you can go through all the stock selectors here, the different criteria, just go through it. But again, make sure you do your own further analysis before you make your own decisions. Okay? Don't just, uptrend support, I can buy one, this stock can buy one. Okay? No, don't do that, right? So you do your own analysis. But we're just providing you the ideas. So that's what the website is all about. All right? Providing ideas. Any more questions before I go to the next part? Okay? So we divide them into stocks, because the way we analyze stocks and the way we analyze REITs are different. So this one is more like if we're going to give you a little bit more in-depth data or information on the REITs market in Singapore. So when you click on REITs Guru, you get this page. You can compare 2 different REITs if you want to. Okay, I'll show you later. But this one will show you the sector yield ranking. The different sectors, so we have office REITs, we have retail REITs, healthcare, industrial, data center, diversified, hospitality. Okay, this is the average yield. Okay. Then we can actually go and dive deeper into the REITs. So office currently provides the highest yield. But again, you have to remember that sometimes the average can be skewed. Maybe there's one REIT that is outperforming much more than the others. Okay, so but we're going to dive deeper later on. Okay, so when I click office REITs, remember I click the office REIT, then it will show you all the REITs that are in the office REITs. There are a total of 8 office REITs in Singapore. Total properties of 253. Right, so this is total. So I can go down and deep dive into each of these REITs. So like prime US REITs give you a dividend yield at current price of 18%. But bear in mind that this is based on 2021 earnings because 2022 hasn't come out yet. Okay, but in the next months, like I say, together with stocks, you will have the updates. Okay. So Prime US REIT, Elite Commercial REIT, Manulife. So you have all this list here, right? This is sorted by the yield again. Highest is 10.65% based on 2021 earnings, right? Not 2022. Okay, we do not know 2022 yet. Okay, until we get it. So capital and the rest and so on. So it will show you in the chart form that I can just click on, let's say, okay, Manulife US REITs lah. Okay, so what it tells you is this is your 1 year return. That means the stock has gone down 58% in the past 1 year. Okay, this is basically the trading data. Now, this is the information where we dive deeper, right? So every year we get this data from their financial reports, we update them. Okay, again, this is based on 2021 figures. You can see this 31st December 2021, 31st December 2021, because that's the last financial report we got from them. Okay, so when we get the new report, this. Okay, so if you look at their, for example, Manulife US REIT, their occupancy rate for all the companies based on 2021 data is 92.3%. All right, there are a total of 12 properties. Their revenue segmentation basically is all 100% comes from just properties because some of them, this is really office only lah. That's why the 100% is actually from office lah, right? Because there are some diversified REITs. They can be office and maybe data centers, right? Or shipping, data centers, or healthcare and so on. All right, but this is purely office. So this will show you that dividends being paid, okay, every year. Okay, so I can go to detail and look at where their properties. So this one mainly US markets. So this one is called Prime US REIT lah. So their properties, their properties are all managed from the US, but they are listed in Singapore, right? So 12 properties are there. If you want to go deeper at the bottom, okay, this is also very important for analysis in REITs, right? So this is your revenue against your net lettable area. If possible, we want it to be close as possible. That means all, if it's 100%, if it's close, that means you know that it's fully occupied. All right. This is how much they can let. That means you know that this thing also will tell you that most of the areas are being rented out already. That means there's not much room for growth, right? Unless they increase the properties. Okay. And then you can look at all the property names as well. These are all the properties that they are managing and they own. Okay, how much the market valuation and all that. So it's quite detailed. So you know exactly where they are. And I click on, let's say, capital. Okay, this is a picture. It will show you the location. This is a mall actually, right? 194,000 car parks. This is their property valuation based on the financial reports. Of course, properties has gone down for the past 2 years. Okay. But 3 years only, we can't get a lot of data. But this, as we go on, when we got more data, then this can be extended further. Because the financial reports only provided 3. It depends on the company. The occupancy rate in 19, 20, 21, you can see the occupancy rate has dropped for the past 3 years, right? The tenant sector is also there. So whatever financial report, whatever report information that we can get from these companies, we'll put down here. Okay. So food and beverage is 41%, beauty and health, and the rest of them. These are the sectors. Okay. So these are the information available at the moment, right? If you can get more information, and it's good that if you are using it, if you have any ideas on what to put in, you can always feedback to us, right? And see what we can improve lah. Okay. So it's quite detailed. So you really dived in where the properties are, how many, what is their occupancy rate, you know, and of course now with the internet you can also check more about, let's say, this Capitol building lah. Okay, this is based in California and Sacramento, right? So we go to that extent. Okay, so so this is basically and Manulife US REIT, right? It's an office REIT. So I can go back again. I can look for, let's say, Capital Pacific Oak REIT. This one also US lah, right? So I look at their properties, mostly are in the US as well. Oh, this one, they don't tell you where the distribution are. They say in the US, but they didn't tell you where the area is. Okay. So whatever information that you see here on the website is our best effort basis. All right, please remember there may be some slight errors, all right? And if you do find one, you just let us know, okay, if you're using it. Okay, so I can compare, for example, let's say Manulife and Capital Oak, because both of them are US, right? So I can just do a comparison. Let's say Manulife. Okay, and select, let's say, Capital. Pacific US rates. I can just click compare, and then you have a side-by-side view. Oops. Let me try first, anyone? Should be working, but I don't know why it's not working now. Let's compare one first. The website is not loading. Okay, let's try again. Oh, I select Capital. Okay, sorry. Sorry. I just compare. Let me try. We should have something like this, lah. But I think this now was the page wasn't loading. Okay, so this basically comparing Capital and First Read, right? So you can see this is the two. So the blue one, the dark blue one is First. This lighter blue one is Capital. Okay, this will show you their revenue, right? So this one, of course, so you look at Capital, they're basically negative for the 2 years. This First Read is basically down for the past 2 years, and now it's probably just break even, right? The occupancy rate for the two REITs. So remember, the right-hand side is First REIT, the left-hand side is Capital. So this one here, the First REIT has 100% occupancy at that point of time in the end of 2021, right? And then you can look at their performance details as well. So this one gives you 10% dividend yield, this one 9.3. Different property, one is healthcare, okay, First REIT. This one is office. This is the market cap. So this 31 properties against 15. This one did not give you an information on the net lettable area, and so on. It also give you a gearing ratio. Okay, so that's comparing. All right. So only stock search, REITs. Okay. Information is there. It's supposed to be easy to use. You don't need a manual. All you just need to do is just click, 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 and then you get all those information. All right. So if you get information, you can always deep dive, whether it's in REITs or whether in stocks. For stocks, you have that 10-year information for now, but for REITs, we only have 3 years. Okay, because we are just starting this, and the financial reports only provided that information until we are able to put in more, then we can put in more. Okay, so that's about it. All right. Feel free to use it. Share with your friends if you can. There's no registration, nothing. Just go in, use already. All right. Any questions before I hand this over to our next speaker, which probably you guys are waiting for? Yes.
The services that you have here is the same for Malaysia as well as Singapore.
Malaysia is different.
Malaysia have more or less?
Malaysia has more.
Malaysia
but
more.
No REITs are not yet. It's coming
right,
soon.
Right. The REIT market here is like nothing.
But for Malaysia market, we have more data.
More data, like what?
we will go back all the way to 20 years when you do the filter. You can also do your filter if you want to. So it's also, this one is fixed already lah. Yeah. So that one is more for, if you're an analyst, you want to do more research deep dive, that one has more features. Yeah.
Thanks.
We built this to make it simple for at least Malaysians because you know we're not so familiar with Singapore market, but this just gives you some ideas lah. Okay. Oh, online. Oh yeah, for REITs we don't have the price chart yet, not yet. Where are we gonna put it in? We will just take this first, right? We'll see whether we can put the price. This is an online question now. Okay. Is there anything? Yeah, REITs got no price chart. But let me just check, right? Yeah, this one got no price chart yet. High interest impact on REITs. Okay, this is a question that Paul's going to answer later. Interest rate impact on REITs. That was a question. Yeah. Okay. So I'm here just to present the tool only lah. Okay, so if there's no questions, I mean, you'll still be around if you need any questions. But the website is pretty much simple to use. It's just that, right? Nothing complicated. So just please feel free to use it. Okay. So with that, thank you so much for listening. I'll just pass this back to Jay. Thank you.
Thank you, Benny.
Sorry, Vera. Sorry.
Oh, another question?
Another question or what? Oh, yeah. Okay. Sorry. If you want to go to the Malaysian market outlook, we have one after Chinese New Year. Okay, this is from EquitiesTracker lah, right? So we'll be presenting our, not really an outlook, but what we see in store for 2023. So this one you have to register. The link is not there, but just let us know. You can go to our Facebook lah. The link is there. This is on the 11th of February. It's going to be here also. Okay, but seats are limited lah, right? We only can take maximum about 70 packs, right? So please do register if you are interested to attend. Okay, but this one is for Malaysian market. Today is all about Singapore market. All right. Okay. Okay. So with that, Joey, sorry. Thank you.
Okay, thank you, Benny. Next, let's welcome our next speaker, Mr. Paul Chew, to talk about the Singapore market outlook for 2023.
So, thank you, everyone. Good morning. Thanks to M Investment Bank and EquitiesTracker for the invitation. Actually, I saw the screener. It's pretty useful. I guess the first one I would do is probably look at the cash holders. Because in Singapore, we have lots of companies that have, some of them have trading even at net cash. And like one of the companies, just for your info, like RX Biopharma, actually we know them quite well. So one of the reasons why they've been losing money is because they're a biotech company. So I won't bore you with it. So for today, I was just going to run through what's happening, the conditions for Singapore. I'll try to skew it more a bit for Malaysian investors because you may or may not be familiar with what's going on with Singapore. And also, my slides are quite heavy, so I'm going to run through quite fast in the beginning and just go straight down more to Singapore and how it maybe hopefully relates to a Malaysian investor. So the usual, I mean, my strategy was mainly about disinflation. Basically, what we're just trying to tell investors is that for 2023, the most important thing to monitor will be inflation rates in the US. So that is going to decide how asset prices are going to move directionally, not just for equities, you're talking about bonds and so forth. This is our usual disclaimer. Now, these are just our opinions. We rely a lot on public information and do seek advice from your financial advisor. So before we go through, we usually just have to run through what happened in 2022. So for 2022, so this is in US dollar terms. So for Singapore, okay, this is a very nice pointer. So for Singapore, what has happened is that we were up in US dollar terms about 5%. You can see on your far right. This is KLC. So what we up strongly outperform Asia ex Japan. This is very heavy on a lot of tech stocks, your Tencent, your Alibabas. And this was a big major outperformer for Singapore because they were down like 20%, so we were up 5%, so we outperformed by 25 percentage points. This excludes dividends, so you can just add roughly Singapore dividends about 4 to 5%. And what has happened is that one of the things that underperform is also the REITs here. So REITs did badly, and you notice REITs also move in line with bonds. So REITs were down about 14%. And this is just for your reference. I think you all know you know Singapore KL market, so it's on your far right. So just for your reference. The next thing is you're probably not familiar with most of the names here, but just to give you a flavor, what has done well in Singapore. So on the top is banks. So banks were up probably 4 to 14. We call it resilience because in 2021, most of the banks were up 20% to mid-teens. The REITs, of course, across the board, most of the REITs were crushed because of higher interest rates. Just as a reminder, when we went into early 2022, most of us thought interest rates would probably only rise from maybe 0.0 to 1%, but it ended up 4%, so that destroyed the REITs and also destroyed a lot of the US tech because of valuations. Some of the outperformers, these are the best performers in Singapore. This is a shipyard, and mainly because of energy prices, and those were the other two conglomerates in Singapore, government-linked companies, and mainly because they did about restructuring, and they also benefit because when LNG prices were up, they had some gains there, and of course, the stock spreads also rise because some of their peers were on LNG. So energy had a lot to do, or commodities had big influence on who were the best performers. But of course, the banks were the ones the most resilient. Worst performers on your bottom right is again all the REITs. I mean, they just totally hammered in 2022. I won't run through this, but I guess it's just for your reference how Singapore currencies perform. So against ringgit, since we're in Malaysia here, we were up like 6 and then up 2. I did this just for Malaysian. So if you want to understand a bit on historically how has the ringgit appreciated against the Sing dollar, so roughly, doesn't mean every year this is going to happen, but it has been around 3% against the ringgit for the last 10 years. Of course, if you do the whole series, it's probably about 2% roughly. So it's quite stable, I guess around 2% a year against the ringgit. Doesn't mean every year, but just for your reference. Okay, so anyway, that's it. For the history, I want to focus more on sector. So for macro themes, this is just for your reference. This is very quick. This is going to be a very quick slide replay because probably most are going to be bored when we talk about macro, and macro is quite a commoditized opinion. So in 2022, what we thought was, of course, COVID will come down, and then we thought interest rates will only rise a little bit, and obviously we were wrong, so that's why there's an X there. What we think in 2023 is that we're going to get a mild recession, and then inflation will peak, and possibility of a rate cut, and a rebound in China and tourism. So one of the main themes for macro as an investor would be the most important thing would be falling inflation. If it falls sharper, it'll be very good for the market. If it doesn't fall, then we're all in big trouble. So for us, we think this is mainly US because the whole world is dictated by where inflation in the US is going. So we think that inflation will fall, and it's actually running at maybe below 3%, at least on the core level. So for the US, goods is falling. Rent is falling. The problem is the red line, it hasn't come down, but because rent is falling, so like 40% of the index is rent. So we think even this will come off because of the way they compute it, but this should come off hopefully by the second half, and that will drag down inflation. And the reason it's important is because then interest rates would have peaked, or at least there's a pause. Of course, container rates, this is the cost of shipping goods from China to the US. Most of the slides are with EquitiesTracker, so if you want, you can just get it from them. I'm sorry, all the slides are with EquitiesTracker, and just get it from them. So this is also good because it also will lower transportation costs. It used to cost $2,000 to want to ship anything to the US. It spiked up to almost $14,000, $15,000. Now it's back to square one. So this is going to at least reduce the inflationary costs. What we are expecting, and hopefully we get it because this is what the market is expecting, is the next two Fed meetings, 31st Jan or 1st February, We hope like 25 and 25. If that happens, then this is what the market expecting. Hopefully it doesn't go higher than that, but the way inflation is tracking, this will likely, hopefully this will be the one, this will be the amount of interest rates that will, at most another 50 basis points or 0.5 percentage points. Okay, I'm not going to run through this. Then we also think there is a high probability of recession, but we think if it does happen, it's also going to be soft. You're always going to hear in the press, negative yield curve. So one thing to think about this is that we always tell for retail investors, this is like your FD rate, your 10-year FD rate. I know there isn't any, but just think about that. 10-year FD rate is actually lower than the 2 years. Obviously, nobody wants to put that, but the only reason it's down is that people either think there's a recession coming, and it has been a good predictor. So the yield curve always declines before the recession in the US. So this time when it goes negative, the market is very wary because the market is very afraid there's a recession. The only caveat we have this time around, it might be pointing to just lower inflation because we never had inflation so high the last 40 years. So this indicator might be just the bond markets telling it that inflation is coming down rather than there's a steep recession. The other thing is, of course, most indicators globally, if you look at Taiwan exports, Korean exports, all electronic exports, manufacturing is all sliding down. In part, it's also because a lot of spending has gone to services and so forth. Sorry to rush this because I know macro is not something that everyone is that interested. And also, recession has been taught. You probably every day there's probably a news on about recession fears, and this is the Google search term for recession is probably higher than even the global financial crisis if you look at the 2007, 2009. The other one last thing on recession is that labor is still strong in the US, and also we are dealing with a nominal GDP or inflationary recession. And during those periods, you will notice that on the far right, earnings don't really drop that much because we're in an inflationary environment. Okay, I won't run through because most of you. Okay, anyway, just back to Singapore. So Singapore economy is very robust. Our retail sales now is trading like 9 times the pre-pandemic. Because pre-pandemic, retail sales in Singapore was hardly anything. It's around 1% a year. Now it's growing at 9 times. This excludes motor vehicles. Some of the reasons why Singapore is doing exceptionally well is wage growth is very strong. Of course, you can also caveat that with because inflation, but regardless, we are still running at the best wage growth since 15 years. There's a lot of jobs in Singapore. For every, of course, there are, if you look at the blue line, so there are probably 100,000 vacancies. If you want to look at the number of jobs available for someone looking for a job, the ratio is about 2.2. If you look at the orange line. So this is back to the good old 1997 days. If you track the data, 1997 was probably the best time for job seekers. So we are trending back to those levels. Household net wealth in Singapore is climbing, is up about 13. I didn't compile this stat, so but this is what the Department of Stats in Singapore does. A lot of it driven by property wealth, and of course, and also they look at how much cash deposits and so forth. So it's up 7% roughly. In Singapore also, we are getting still is a very strong destination for foreign investors. We're trending about 100 billion. The red line is ASEAN 5. That means all the ASEAN countries combined, it's about 80. So we are higher than all 5 countries combined. And of course, we're going to get this big tourism boost when China reopens. This is like, just think of this like your room rates, okay, your hotel room rates, but there's an occupancy into it. So it sounds a bit more complex, but it's like revenue. So even before Chinese tourists come in, it's already, if you try and book a hotel in Singapore, it's probably the highest ever. And this is even before the China reopening. This is important for Singapore because tourism is about 5 percentage points of GDP. And we're not like a ultra high growth. So 5% is a lot for us. Our valuations are cheap. The consensus, we are looking at maybe 13% growth. And the one way to read this chart doesn't mean it happened all the time, but one way to read it is that whenever it goes below the orange line, the valuations should bounce up most times, statistically at least. Of course, this time around you have higher interest rates, and even if you overlay with the higher interest rates, you're probably trading about average, probably at the green line if you take into account, because you cannot use the low PE because at the time there was no alternative, right? FD rates now in Singapore probably like the high 3%. Okay, sorry, I had this chart. So basically, it takes into account the higher interest rates. And the China reopening will benefit a lot of stocks in Singapore because a lot of Singapore companies have a presence in. I mean, for the banks, because we have Hong Kong, most of the banks in Singapore, DBS and OCBC, they have presence in Hong Kong. They have a subsidiary. They have a bank in Hong Kong, and Wilmar, has soybean crushing. They sell branded oil. I won't run through everything. I mean, Genting is also because they are high rollers from China. So a lot of sectors will benefit, and almost 3/4 of the index. So you want to play China, you just go buy China. No one's going to buy China through Singapore, but we will get, most of the corporates is going to get earnings tailwind from reopening. Even ComfortDelGro because they have taxi operations in Singapore. So Singapore companies are very heavily invested in Singapore. Percentage of sales, it varies. Some can be 10, some may be up to 20%. Okay, I'll move on to sector trends, and then maybe I'll slow down the pace a bit so you can understand a bit better what's going on in the sector. So for the banks, it has been a great year for the banks, mainly because of the rate line. So NIMS, which is if you look at, it's a bit hard to see, but if you look at 2021 to 2022, you see the rate line just spike up like a rocket. So it's because interest rates have jumped up a lot. And the difference for Singapore banks, I guess, compared to Malaysian banks is, because here you have no bank negara deciding on rates, but for Singapore banks, we track very closely to where the Fed funds rate. So if you look at the dark blue line and the light blue line, sorry if it's a bit faint for some of you, you can see we are virtually like we replicate where the Fed is going, directionally at least. So when the Fed raised rates, all the interest rates in Singapore just spiked up like a rocket. It's like it just, and that benefit the banks. So just to give you a refresh, how the banks benefit. So firstly, of course, when interest rates go up, all homeowners are going to get higher interest. You just have to pay the banks higher because your mortgage just went up. Then the second thing is a lot of the banks in Singapore have a CASA, your current account savings. So some of them they have billions. I had to slip my mind the amount, but so most of these don't pay interest. And then now that interest rates are up, they can just park their excess deposits into higher interest rates on the short-term rates. Of course, it depends. Some of them have to mature, but that's how they benefit. They obviously tell all the housing owners or whoever lend money, hey, you have to pay me more. But my cost doesn't move much because my cost is CASA, current account and saving. Don't pay us much, it's hardly anything. Now it's a bit higher. So that one, they're getting like a free ride. It's a free float, right? You have this amount of money, doesn't move. So when interest rates, I can charge more, but my cost doesn't go up. So these are the two ways why banks have been doing well. So in terms of where the risk, of course, the worry is that if there's a slowdown, where is the risk? So housing loan is not an issue for Singapore because most of the loans, you need to have, there's a TDSR. So the government imposes that you need, that your pay must cover at least 50%. That means you have, your mortgage payments must at least be more than 50% of your pay net of all your credit card bills. And so there is an overlay. That's why we never worry of housing loans, because unless you lose a job, which I think we've seen, vacancies are ample in Singapore, and you over leverage, right? But the banks cannot, because the MES already tagged that since 2013. Of course, that also caused the property market to come down. But so the only worry we have in terms of where there is possibility of risk is the rate line. So financial institution loan, you always worry about the risk is that when the banks lend more than the so-called blue. So this green line is the loans growth for the banks, and the red line is where where areas where it's lending more. So these are mainly your REITs and so forth, that when they went on the acquisition, not binge, when they went for acquisition drive, that's where they lend the most. So that will be the part that are risky. Anecdotally, where we see the risk is probably loans to Chinese property, to second-tier cities, maybe some in Malaysia, and then of course there are some loans that we see to emerging countries like Myanmar and so forth. But the local banks don't really have that heavy exposure. Maybe the foreign banks have that. So that's why we think in terms of the NPL provisioning hitting the banks, we don't think it will be that steep because regional economies are strong and domestic economy is strong. So that's why we're not too worried about the asset quality, especially with China reopening, which was the other area of worry. The only problem for loans in Singapore is that there isn't that many places to lend. You think about Singapore, who do you lend? You either lend to housing, and business isn't that great. So that was one of the reasons why we had the oil and gas issue, because that was 2016, that was 2015, 2016. That was the only place where there was a lot of loan demand. And you know, the problem for Singapore is just where do you lend, because there isn't that many pockets to lend. Okay, so we move on to REITs. So for REITs, okay, think of this slide as, although we use 10-year government bond, but just to make it easy, think of it as like fixed deposit. So if my fixed deposit, how much interest rates am I getting more? So if my fixed deposit is 2%, just example, then if you hear here 3 means I'm getting 5% dividend yield. That means I'm paid like 3 percentage points more than my FD. It's bonds, but just to make it easier. So on average, if I want to buy a REIT in Singapore, usually you're paid, this is average, right? So usually it's about 3 percentage points. So this is a good way to track, like, am I buying at the right dividend yield, right? So right now, most of the REITs are paying like maybe 6% roughly, you know, 5 to 6. So not all not all REITs have priced in the highest interest rate. So we think that's why we have a neutral and only very selective, because I'm being compensated for the risk. So it's not about just buying the REIT because the yield is low. So number one, I need to be compensated more than in the past, that 3% here, mainly because there isn't going to be much growth for REITs. It's not going to grow. If the DPU can grow, you can just stand out and clap hands, because interest rates are rising. And number two, there's nothing to buy, because when interest rates are low, you maybe borrow at 3%, then you buy the property yield, like you rent a home, you know, if you are a landlord, you know, you rent a home maybe 5%, you get a 2% spread, so it's worth it. But right now, with interest rates so much, it's negative carry, you can call it a more complicated term. So what it means is that there's very few acquisitions that the REITs, so REITs used to grow because they acquire. Or I borrow at 2, the property I purchased 4%, then I got 2% spread, and then I gear it, then I can have a positive DPU growth. But now that window is obviously closed, unless you buy in Japan and take exchange rate risk. But that means for us as an investor, for us, you know, as analysts, we need the REITs to give me at least a 3% yield above the FD rates or bonds, because I know your growth is coming off. There's virtually no way in the next 2 years you're going to grow. So that's why for REITs just have to be a bit more not say wary, but we want to get those that have been better price yields, because there's no growth compared to in the past. In the past, you could take a little bit because you know these guys can grow their dividends, 10% or so. Okay, this is a bit more complicated. So because we like prime, so just to show the spread historically, so we want to see like who's giving us a yield spread that is better than in the past. So most of the REITs aren't really giving. So most of them are then bunched around the 2-3%, which is quite similar to what they were getting. So they are fairly valued for us. That's why we have a neutral. But the one that stuck out for us was prime, because the price has been sold down so aggressive, which I will elaborate a bit more like who, because probably a lot of these are foreign to you. So first, the overseas REITs are where the opportunity is. You can still buy the Singapore REITs, just that we don't find them cheap enough for us, I guess. I will run through a bit because most of the names you probably were not familiar. This is just a sensitivity. So what it means is that most of these REITs are going to have high interest rates. So if you assume 2 percentage points higher, this is going to be the impact on their DPU. You won't get this immediately because most of them are hedged. So you probably feel it in the next 2 to 3 years. But of course, they can also grow. They can still grow the rents. So that's why we are only very selective, because we want who can reprice, which I will discuss later. Who can reprice the rents faster. So for us, some of the ones that we like or we cover for prime US REITs. So because they are hedged, so the impact to them is quite minimal for now. And because they're not so highly geared, their gearing is about 30% plus, the impact from higher rates isn't that significant. The other one that we also like is a Fraser Centrepoint Trust, which, just to sidetrack a bit, since most of you might be interested in REITs. So this one is the most safer. If you want to go into REITs into Singapore, so Fraser Centrepoint Trust is probably the one is stable, because they mainly own suburban malls. So they own malls, not in Orchard Road. Okay, probably that's the easier way to explain. And why suburban malls are so defensive is because they are like a monopoly. So I mean, okay, so it's not like in okay, let's say in Malaysia, you have a very popular mall. Probably in a few more years, your neighbor will have another one. But in Singapore, it's very controlled. So once you have a mall there, there's hardly any in the next, probably 2-3 kilometer radius or more. So once you have a mall there and then you have an MRT attached to you, you are safe for almost forever, because there's no other place. You can ask any Singaporean. There's only 1 or 2 malls they can go, because there's hardly any. So Fraser Centrepoint is one of those, because they are mini suburban. That means not in the CBD areas, and of course they are in the MRT routes, and also they are in areas where the government, because Singapore government is trying to promote out areas like Jurong, Woodlands, so that they want employment to move there. They want population to grow, so not everything is congested in the core central region. Okay, then I'll just run through a few sectors before I go to the stock picks. So for sectors, Singapore construction is doing well. So we had the big collapse in 2020. So what happened in Singapore, probably is quite similar here in Malaysia, is also you couldn't get any workers because everything is shut. And then you could not work because there are so many restrictions. And then what happened is you got this big bounce. So of course, construction companies is not something we recommend in Singapore, because I mean, the longest expressway in Singapore is probably only 40 kilometers. So how much expertise do they have, right? So for us, we like the building materials. So for us, though it's not on the slide, we like Penn United, because they have very strong market share. So for construction, we only play the building materials because they have like 40, some even have 70% market share. So you don't have to worry who has won a contract or who hasn't. But I need just to give you a feel, construction activity in Singapore has bounced back strongly. And that's good for the economy, of course. This land transport, this is more Comfort Delgro stock that we're going to recommend later. So for us, land transport, of course, with the reopening, it has done exceptionally well, not only in the volumes, but also on the price, because Singapore government has raised public transport fares. But the public will only pay 3%. The rest of it, the government will just pay directly to the public operators. So this is ride-hailing. So this is street hail, that means taxis, and then this is ride-hailing, which is your Grab and so forth. I will skip this part. I'll just move on to property. Probably that's where Malaysian investors are a bit more interested. So this is the whole property cycle in Singapore. After the global financial crisis, on the left you can see we had a big rally, almost 60%. Then this TDSR was the one that killed the whole property sector in Singapore, because that was where I told you where you have to impose wage. So you basically cannot. You can only buy a property what you can afford. Like you can't just go and speculate. Even your income level is not good enough. So that really hurt the property market. It was down 12%. Then the government relaxed the rules a little bit, and then the market rally again. Since then, they imposed a few cooling measures. That means they raised stamp duty, but the property market still continued to climb. So you can see, like, from 2018, it's up 17, and the most recent measures they imposed end of last year, they still. So some of the reasons why property is strong in Singapore is because there's a lack of supply. I'll show you a chart later, and there's a strong resale market. So why is resale important? Is because resale and HDB. So there's this thing called upgraders. So once you sell your HDB, which is the government, I won't say flats, but it's government housing. Once you sell it, you get like 100, 200,000 of equity, then you can upgrade to private. So this is private property, this is not, and the government actually gives subsidy for those who want to buy resale. So if you are individual, you want to buy resale, they can give you as much as 160. Think of it like an ang pao, like 160,000. That's the max, because some can be 25 depending on your standing. So the government will need to give you 160,000 grant or subsidy, and with that, a lot go, they'll buy HDB, and then the person who sells it will have the equity. Maybe he made like 1,000, then he move into property. So as a result of this, property market has been extremely vibrant in Singapore. Inventory is very low. So on average, it used to be 3 years, but now it's probably hovering about 1 year plus. So that is one of the reasons why demand is very strong in Singapore. So for healthcare, I think I'll just skip this, but this is actually taken from the Malaysian listed IHH. So in Singapore, a lot of the healthcare, the hospitals did very well because of COVID revenue. Right now, they're doing well because a lot of Indonesians are coming back to Singapore for medical tourism, plus a lot of elective surgeries. So a lot of surgeries that were postponed and then now it's returning. So for Singapore Electronics, we are quite heavy on semiconductor companies, and we are very heavy on semiconductor equipment makers. Might be a bit alien for some of you, but anyway, there's a downturn happening for semiconductor. I think it's pretty obvious. The downturn can last 12, 18 months. It's really underway. Possible timeline is no more like 90% guess. We probably end of 2023, the downturn, and the downturn the downturn is driven by, of course, memory and China. So just to give you a flavor why there's a weakness. So if you look at PC demand, you know, our laptops, desktops. So during the pandemic, the demand just spiked up 25% a year. And then they just gave back everything because everybody just bought. They probably wanted to buy the PC in 4 years' time, but everybody just had to buy. Then now you're feeling this. So the last 2 years, smartphones is also isn't growing well, it's declining, but smartphones is like a 1.3, 1.4 billion. So because of that, hardware sales is contracted. So a lot of people, you know, they pull forward their demand and so forth. The other thing is, okay, foundry capex might be alien for you. So foundry capex is more like TSMC and so forth, but I think I won't run through maybe a bit more. So the end demand. So for telcos in Singapore, just to give you a flavor, from 2008 to 2016, it was those were wonderful years for telcos because you know all of us had SMS. They can charge you for SMS, the international calls. Then from 2016 onwards has been really bad for the telco sector in Singapore, for your StarHub, your Singtel. In Singapore, there are 4 mobile operators. There was used to be 3. Then when they introduced one, everyone just cut prices because they know the new operator is just going to cut. So I will just cut before him. And of course, we all know the WhatsApp effect. No, there's no ID calls. There's no SMS revenue because of that. Then recently, there's a roaming collapse. It's probably going to be the same for some of the telcos here in Malaysia, but it's a bit more for Singapore. Because probably 30–40% of the profits can come from roaming. So with the recovery, the telcos in Malaysia, Singapore would perform well because of roaming revenue. I'll try and run through quickly. So for the other sector that is doing well in Singapore, one of the best performers has been oil and gas. Of course, you have it here too, but ours, some of these are the shipyards. So they're the ones who build the oil and gas vessels, the rigs and so forth. So you can see from the blue, this is the order book spiked 3 times. So so in Malaysia, a lot of the yards did well because all prices jumped up. And if you look at oil and gas capex, so this is the oil and gas spending, the red line. This is spending by your BP, Shell. You just combine everything, a total, excluding Saudi Aramco, because Saudi Aramco doesn't have such a long historical number. So you can see that the capex has jumped up a lot by 40–50%, and that gave a boost to all the yachts in Singapore. So that's why marine yachts are one of the best performers. And also, you also notice that even though oil price was 100, you're not getting the spend they had because they've been burned, but they're not getting the spend in 2013. So as a result, of course, this is one of the reasons maybe oil price can sustain, because even though oil is high, but you not get, in the past they were spending almost 300 plus billion, now it's at most only 200 billion. So they're nowhere near what they were spending in the past. Okay, so I'll spend a bit more time for what are the stocks that we like. We usually have a model portfolio, okay, just for transparency, and so what we did is the new stock that we added is Prime US REIT. I think the equity screener, EquitiesTracker screener also mentioned this. So the way we design the portfolio is we just have like yield stocks, then growth, and then re-rating. Like Capital Corp is a re-rating because they're going to sell off some of their loss-making business and sell off some of the non-stuff. So these are the stocks that we like, and we will run through primarily some of these stocks. So the first will be the banks. So banks, this is the third quarter earnings. This slide is just to differentiate the performance of all the three banks. So the first point, if you take notice of, is how they did. So this year-on-year growth. So the bank's net interest, that means the income they earn from interest, jumped 40%. And this is like a small cap. This is like the high-tech stock. This is like the tech stock in the US kind of growth rates. So because of high interest rates, like we mentioned, they can reprice the loan faster. They got excess deposits. So that's why we think the next few quarters will still be strong because of high interest rates. That's because there's a lag effect. And also the other thing is that we think the dividends can surprise. They're paying about 4 to 5% dividend yield. And because their CASA ratio, I mean their CET ratio is still high. Most of them only need like 13.5. So it could be dividend surprise. So that's number two. Number three, what differentiates the Singapore banks from possibly even the Malaysian banks is this line. So, sorry, this is the CASA ratio. So Malaysian banks probably 30, 40%, but in Singapore, they have a lot of cheap deposits. So this is the strength of all the banks. So what this means is that if DBS ever, I mean, that's a side, if DBS ever wanted to compete, they have the cheapest costs because their CASA is so high, no one can compete with them. So that's why we like DBS and OCBC, because when you have high CASA, it means you will have the better net interest margins, because your cost of deposits, right, doesn't really move. It's almost zero, because now they moved it up a bit, but it's almost zero, but you can charge all your customers higher, but your cost doesn't go up. The other thing was that UOB did very well because they didn't have any China exposure. They hardly, although they had this Shimao incident, but I don't go into that. But they don't have as much of a presence. If you look at the last line, their China exposure was smaller. So the investors like UOB because because investors were wary about any bank with China exposure, because it's the black box, right? Who actually knows the quality of the loans? But right now with China reopening, we prefer the DBS and OCBC mainly because of the CASA, better leverage to interest rates. Number two, China exposure. Right now that it is turning around. And number three is also because of the capital they have. So higher capital is also bad because your ROE is down, but it helps in the dividend. So we think there could be more dividend upside for DBS and OCBC, which the yield is at the bottom here because it moves around. The other stock that we like is actually XGX. This is XGX like a Bursa, okay? So the only difference is that SGX has a lot more derivatives. So they do a lot more futures trading. And this is important because with futures trading, for your MSCI, sorry, not MSCI, so it's more FTSE now because they kind of like, so it's more like for equities in India and China. So what this means is that you can get global flows. So if you're just doing Singapore, there's not hardly any global flows. So the strength for SGX is because they move into derivatives quite aggressively, and they're also moving into FX. So for SGX, they have equities, of course, we all know that. Number two, they have futures trading for equities and also for commodities. And number three, they also have FX, foreign exchange, and they're moving to OTC. But so that is good. So I think, but the main thing why we like SGX is because of this thing called treasury income. So for when you're running a futures exchange, you have to collect deposits. It's like a bank, you have to, because after the clearing house, right? You do not want your member to trade so much, and then just run away. Then you got to carry. So there's always a float. So for SGX, they carry like a 14 billion Sing dollar float. That means you partner money in me, and then I will put your money into the exchange, but you got to give me a cut. So when interest rates rise, SGX will benefit. So they give you a flavor, because it's very hard to predict. Now they don't give, just to give you a sense. So if you look at SGX trading income, so SGX makes about, I think about 400 plus million a year. So if you look at their treasury income, it was about 140 million. And this was when the Fed rate was about, I think, 2.5, right? So now that the Fed rate is up to 4, we think there is a huge upside to their treasury income. It is hard for us to pinpoint and forecast. I mean, we sort of don't want to be too aggressive, but you can see directionally that they could actually get an additional. So right now, their treasury income, which is like net interest income, is about 50 million. Just put money in the bank, is probably the best business to do. And we think that with interest rates rising to record, they could even exceed the 150 million. So they could get another 100 million or so in extra income by doing nothing. I mean, I'm not saying not doing nothing, but just parking money in the deposits. Of course, it depends on collateral balance, but we think it is another underappreciated beneficiary of the high interest rates for SGX. Okay, I think I'm running short time. So the other one that we only recommend 2 REITs here. So one of them is CapitaLand Escort. So CapitaLand Escort, they're most service apartment and hotels, and it's across the Asia Pac. So on the left is where they are. They're in Japan, in Singapore. They're also in Europe and US. So why we like hospitality? Of course, we know there's a big rebound, but mainly because they are getting repriced faster. So if you own an office, let's say you own an office asset in Singapore, your average is 3 years. When your tenant will only renew in 3 years' time. But for hotel, when rates go up, it just goes up immediately. So that's why we prefer hospitality REITs, because their revenue can reprice fast. You don't have to wait 2-3 years, and then you can call your tenant, hey, okay, I'm going to charge you more. So for this, that's why tactically, of course, the big rebound, we like CapitaLand Escort, and it's part of the CapitaLand group. And also they're mainly into service apartments. They're also moving to student accommodation and so forth. And okay, I won't run through too detailed, but one of the things you can see here is revenue per unit. So you're getting this big growth in it's actually room times occupancy, but just think of it as room rate, so easier for you to understand. So you can see that there's a big bounce now. Third quarter is 132, and then so it's like almost doubling, and you should expect the fourth quarter to rebound. So this is one of the ways that we are playing REITs, is hospitality. So they're giving like a 5% dividend yield. I think it's really coming close to our target price, but because one of the reasons is that when we measure returns, we measure dividend yield and also capital. So like capital return maybe 10%, then the dividend yield 5%. But if they can reprice faster, this part here, then at least they can outrun the higher interest expense, because the rest will have a bit of issue, because this one they can reprice fast. And the other hidden thing is also because if you look at their assets, if you track them, I mean, most of you don't know, but if you track them, they managed to sell some of their properties like 40-50% above valuations, which is a bit strange. I mean, you probably have to sack the valuer, right? Why you value my property so low? One of the reasons is because a lot of the properties are in very good location. Because your own hotel, you can't have it in Kajang. I mean, like Kajang. I'm sorry, not insulting Kajang, but they're saying you probably have your hotel or service apartment in the CBD areas. So the one hidden asset they have is that a lot of their assets are in city centers. So whenever they want to sell, they can get like a 40-50%. Because then you, of course, you only pay the high if they take the property to redevelop the property. But anyway, this is just a side note. Why we like this REIT. The other one is, of course, Prime US REIT. We get a lot of complaints actually. We have some clients complaining, why you recommend this or that. But for the price has come down so much. But that's the reason why you recommend, because the price has come down so much. So one of the things is because of the yield is high, and they are trading at 50% discount to book. So of course, everybody asking, who gives such a high yield? So let me give a bit of background, what happened to the US REITs. So in general, there are only probably 4 US REITs. There's one called Manulife. So what happened was that when the whole pandemic happened, of course, everyone was worried work from home. So the initial thought was that many people won't, in the US, they already quite advanced, so most of them were already working from home. But it didn't happen. Actually, it has been especially bad in the US too. So a lot of people, their occupancy in the office is probably like 30%. That means only 30% have returned to office. And also, then as a result of that, the market was surprising. Then because of that, a lot of tenants shrunk their space. They didn't shrink it in 2020, 2021, probably because they were not sure what's going on. It was very unclear how much office space you need. But now that there's more clarity, you see a lot of tenants shrinking. That hurt one particular REIT because they were Manulife REIT because they were the first to list, and they are like the bellwether. I mean, everyone will watch them first before they buy the rest because they're the largest, and that hurt them because one of their properties was down 30%, and mainly because they're in downtown LA. So Los Angeles is a very bad market for office in general. So for us, we like it because they're diversified. They are well diversified. We don't think the valuation of the assets will be down that badly, and their gearing is only 30 plus, whereas the rest are almost close to 50. And the other thing, of course, the interest rates are hedged, and they also have been enjoying rental reversions. So they don't have anything in LA, they have San Francisco and so forth. So that's why we think that the market is a bit is underpricing them. It's taking on, it's just devalue them too much. And we think as an investor, we are compensated for the so-called risk. So they will be releasing their results early Feb. The market will be watching if they do a major devaluation of the assets, which we don't think, because if you look at the recent devaluation of office assets in the US, at least we take Manulife, the highest was 30%. So that property was, I think, 15-16% of their whole total property of their assets, and that hurt the stock, and the market was worried. Half of it came from that, but the rest were only like 2 to 5%. So we think, in general, most REITs, even in Singapore, if they do get devaluation, it could be probably only 3 to 5% if it's depending on the discount, because interest rates have increased, right? So your value of your assets should come down. Okay, let me just run through. The other one that we like is Keppel Corp. So Keppel Corp is mainly because there's a big restructuring. They're going to sell off their marine yacht to Sembcorp, and if they get that, they will cut off a loss-making arm, and also they get a 500 million cash. This is the impact on the right. And also, what's happening in Singapore is that they're getting more, they're getting higher spark spreads. So spark spreads is basically they're getting more margin from the electricity, which is a bit myopic. I mean, which is a bit of a black box here because sometimes they don't not really clear on articulating. But we think because LNG cost has spiked up and theirs is more linked to I mean, it's a bit technical. Yeah, theirs are more linked to HSFO. But anyway, so that's the other stock that we like. Once they have the completion of the divestment, then maybe you get another kicker to the share price. The other one is city development, which is if you want to play property in Singapore from a stock market point of view, there's only one. There's only city development. There's no number 2, number 3. This is the only one for property development. Previously, there was Capital Land, but they sold off their property development arm. We like it because number one, in this upcycle now in property, he who has inventory is the winner. Because like I told you, there isn't much inventory anyway. So we like it because they have enough inventory. They have a lot of inventory to sell, about more than 1,008 units. And number 2, they also own hospitality. Sorry for the table on left, there should be a title there. Basically, that is the RevPAR again. So they own a lot of hotels, mainly in Middle East and Europe, under Millionaire and Copthorne. So our target price is 886. Their own RNAV, of course, the company has their own. I mean, it's probably about 50% discount to this. For us, it's about 30% discount, our target price. Of course, I think the share price is like 7 something now, not really. So this is the other company that we like if you want to play the rebound in property development in Singapore. And of course, if you want to buy hospitality, every hotel is going to do well. The other one that we like, this one is under my coverage. Okay, so I'm the only analyst here, the only analyst that covers this stock. So it's this company called Del Monte Pacific. So they are based in Philippines, where they have 90% share. So if you go to the supermarket, it's only their product, it's nobody else, right? You got 90%. Your competitors are probably at the lowest shelf. What has done well for them is in 2014 they acquired their US, Del Monte, and what happened is that when they acquired that company, they had to do a lot of restructuring and so forth, because that company, when they acquired, was only focused on just being a manufacturer. They were not focused on building brands, they just want to be outsourcing because they were focused on pet foods. But for this, you can see that they are launching a lot of new products, and also most at 75% of their products are $2 and below, which is actually doing well in the US, because in this inflationary period, a lot of US consumers are not dining less in restaurants. They dine more at home, and they are just using it. So these are some of their key products here, and their margins are at record high. They managed to reprice their product. I think the last 18 months they price it up, because when it's below $2, I guess it's easier to reprice it. So that's why their margins were record high, and their most recent results, earnings was up 30+%. So this is the historical chart of their earnings. So what has happened is that in 2014, when they acquired this US company, there was a big drag. They actually spent, I think 1.7 billion to acquire. And then they had to turn it around. They got to change management, shut factory, restart the whole new product line. And that's why you only see the rebound here. So this year they've grown like the first half about 30%. So that's why we think they're still at the early stage. They are only 4 times PE. The one overhang they have, like most consumer stocks are trading 18 times, 20 times. Why is this 4 times? It's because of the debt. So once they acquired this company, they were settled with debt, and the debt is about 2 billion worth of debt. So of course, a lot of investors are wary, but for us, the reason why the debt went up so high is because of a festive season, the inventory is up and so forth. And also because what we think is that if they do decide to list the US arm, that will be the big catalyst. The timing is unclear, but if they do that, then you will see the gearing decay. So the big overhang is just the debt. So a lot of investors are just holding back because they're just a bit wary. But for us, we think because the growth and the cash flows coming back in, we think we are not that concerned. ComfortDelGro, I won't run through this in view of time, but they are a taxi and train operator. I get a lot of flack for this because I always recommend it and this hasn't moved. So one of the reasons they have done well in Singapore, the earnings has, I don't know, 3-4 times. Just that in Australia and China, they were hurt because in China they own a taxi operations, and because of the COVID, they still have to give like almost 15 million worth of rebates. In UK, Australia, they own bus operations, and because their contracts only price every year, and also on the CPI, there's a bit of lag before. That's why even though there's a reopening in UK and Australia, they're actually performing worse if you compare to Singapore. But we still like it because in the pandemic, they generated almost 900 million of cash in the pandemic. Just the last few for me. The other one, a small cap stock, the liquidity isn't great, but they are buying back because they're buying back shares almost every day. It's a HR company. This is very, well, there's only one HR company in Singapore. Probably the only reason why we like it is because they are not only in Singapore. So you can see how they have grown. So they've been, I think more than 30 years. So they've grown from KL, Singapore. They have professional recruitment, your usual headhunting, and they also have flexible staffing. So flexible staffing is sometimes the hospitals will ask me, I need some short-term temporary staff, and so they will go and hire people, let's say for a vaccination program. I'm just taking an easy one. Then they will pay the staff, pay the salary of the staff. So to play in this game, you need a lot of working capital. You need a lot of financial power, financial firepower to play this. And they have like trade debtors of 200 million and cash of 300 million Sing. So one of the reasons we like it is that they got more than 700 recruiters. this business is easy to enter. You probably got some headhunting companies only 2 to 3 employees, but to have 700, that's a different ballgame. That's why their ROE, officially their ROE is 16%. But if you take out the cash, of course you can argue, they need the cash, but they already have 200 million tied up in trade debtors. That means they fund all the salaries of the employees. Their ROE can be as high as 200%. It's because their fixed asset is nothing. They probably have a few laptops and that's it, because there's only 2 million, probably one expensive car. Because most is a very low capital intensive, and every year they will just generate cash for you, probably 50, 60 million. And they, over the last 12 months of 2022, they gave back almost 100 million. Some of it is buyback, because not everything has been paid out, but dividends and share buyback, they did give back 100 million, and you should expect them to continue this buyback program. The other one, this is a Malay company, we just added in here because maybe it'll be a bit more comfortable. So this Civilay Axis, so they are the banking software leader in ASEAN. I think a lot of the banks here in Malaysia use them. It's a bit very difficult to explain software to investors, but basically this is their main product, the SIPS product. So this is the core banking system. It's on a mainframe, because the problem is the banks do not want to change or cannot change. So this is the core banking system for funding for transactions. So every bank will have a core funding, then you have all the applications on top of it. I won't run through Mobius. I will just run through. So we like it is also because even though in the middle of the pandemic, banks are not going to spend anything. But you will notice that they have a lot of maintenance income. So the best maintenance income if you're doing technology is software. Because you want to change anything, you got to call him and change it, because you can't go and fix it. You can't call another hardware guy. So most of their staff is actually in the bank. It's like almost permanent stuff. So you want to, I need to add one new deposit feature, or you have to call them because it is their software. So even though the pandemic was down, they managed to maintain the earnings well. The pandemic was down because there wasn't any projects. Bank earnings, that wasn't a priority. I don't think any bank want to spend anything. But now that the cycle is turning, we think earnings will rebound quite sharply. So we only have one software company in Singapore, and this is the only one. Ironically, it's actually from Malaysia. Okay, this is my last slide. So these are all just for information. So if you want to know Malaysian companies listed on SGX, this primary listing, this is not like a Top Glove. Top Glove is secondary. So these are some of the, so we have glove makers here. Then this is an auto trade distributor. Of course, with Civilay Axis, this is a Tong Kwe Ong company, Avaga. We have Coco Tourism. This is just for your information. This is Isaac Healthcare is actually, if you go Mid Valley, the eye care, the large one there. So this is actually Isaac. Heartland is Malacca and so forth. This is just for your info. The one that is actually done well for is also some of these iron ore miners. Some money on Pahang, some Johor. So they actually did very well. There are only few pure mining companies that actually are profitable and they are listed in Singapore. Okay, and now I just come to the conclusion. Sorry, I have a chat fast because I only have 1 hour, but so this is the conclusion where we think the Singapore market, or in general, we think we could be in like a mini Goldilocks. So what we mean by that is that not too hot, not too cold, but not too hot means inflation isn't that hot and it's coming down. Not too cold, it means growth will slow, but it won't like totally collapse. We call it mini because it's not the best, because I think growth will still be weak, but it won't be like the risk of a deep recession. Any recession in the US will be shallow. We got no major deleveraging. You know, in global financial crisis, we have banks failing. Because the only deleveraging is probably in crypto. And then Singapore economy is in great shape, and these are the sectors we favor. You notice that we still like REITs, even though it's neutral, because this is mainly based on our model portfolio, not what we like. These are our analysts, and then I think we can go straight to Q&A. Yeah, if you have any. Yeah, I think it's a gentleman.
Hi, good afternoon. I have 3 questions.
Yeah, sure.
The first is, what are your views regarding UOB's acquisition of Citibank's consumer banking operations in Malaysia and Thailand last year and Vietnam this year. So would UOB be a stock for us to consider?
Yeah. Oh, okay. I'll take it one by one.
Okay.
I guess I forget. Sorry.
Okay.
Yeah, I think the acquisition is very positive because this Citibank, right? Citibank has all the customers. Especially, they could be getting customers that UOB could never had a relationship for. Near term, there's an impact because, and it might actually benefit Silver Lake Axis, who knows? But because whenever you acquire this, you have to do a lot of software integration. So near term, there's a bit of impact on capital and in a bit of earnings because you have to spend, right? But longer term, it is a good acquisition to make. UOB Bank, all of the three banks apply for us because there's a tailwind. Just that for positioning, we just like the other two because of the high CASA and the China exposure, which isn't a bad word now. Yeah.
Okay, my second question. Now, I love Changi Airport. So I was just wondering, when will Terminal 5 be completed? And I was just looking at the plans. It appears like as if they're building a whole new airport rather than just a terminal. So once completed, will that give a tremendous boost to the Singapore economy?
I'm not sure when is the completion because there was a bit. They initially stopped it. They were thinking of scrapping it, but I think thankfully it would definitely benefit. But you know, Singapore has to plan 20 years ahead. So even if it comes on, it will help. But I'm not sure the impact will be immediate because this is like a 20-year plan. It's like China, not a 50-year plan. So it would definitely benefit from tourism. So, but the immediate impact will be only on construction. The construction industry, because when you talk about Tuas, they keep smiling because it's a multi-year. Also, not Tuas, Changi. Tuas is another big project because they're shifting their port to this big port. Yeah.
And my third question is regarding the Singapore girl. I understand that she is now flying regularly, she's making money, and then, if I'm not mistaken, she even paid dividend to her shareholders.
Yeah.
But I was wondering, what is your view regarding her interest to purchase a 25% stake in Air India? Is that a good deal?
Okay, I don't have the details of so I apologize for that. The details of Air India acquisition, I'm not too sure. I don't have the details. I don't dare to comment on that. But the general reply we give for most investors when it comes to airlines, you know, airlines are a good trade, but the pandemic kind of shielded the weak economics. You know, before the pandemic, they were having problems. I think SIA, everybody knows, they got Middle Eastern airlines at the top and then low-cost carriers at the bottom squeezing them. As the trade, I think SIA is fine, but do note that from the pre-pandemic kind of shield, because everything just bounced back up. Yeah. So, but the Air India, I apologize. I don't have the details, so hard to comment. Yeah, sorry for that.
Hi, good morning. Do you have any thoughts on Tuan Sing since it's property related?
Oh, okay. We met Tuan Sing before. Tuan Sing is making, I don't have the detail, but Tuan Sing is making a bet on Batam, which we are not very sure. They are building quite a huge development in Batam. They are also redeveloping a major piece of property, I think in Melbourne, if I'm not mistaken. So we don't have an insight into whether Batam is going to do well. So these are the two main catalysts for Tuan Sing. We don't cover them, but I mean, we met them before. Yeah. So the Melbourne looks good because I think they could redevelop it, and they get. I think they're getting extra plot ratio, which is again, it's like an umpire. You get plot ratio, you can just build higher. I think they're redeveloping it into some property units to sell. But of course, the housing market in Australia isn't that great. But the key determinant is your view on Batam, which we just do not know. So can't give a comment on that. But these are the two main drivers of Tuan Sing. Yeah.
I have a question on the impact of COVID. Yeah? What's your view? There are certain view about people say, this one regarding airline and travel. People say that after the COVID, because during COVID, a lot of businessmen are not traveling. They are doing a lot of meeting via Zoom, etc. So they say going forward, there will be less and less travel by businessmen, and this will impact basically airline like Malaysia Airlines or Singapore Airlines. So do you agree with that view? Number one. Number two, similarly, on the office space, there will be less and less people going to the office. And in fact, in some countries, people refuse to go back to the office. And so this will have an impact on the office REIT or office business. So what's your view on those two things?
Yeah. So the first one on travel, you are right. I think most business won't do the regular traveling. They won't do like one, 2 days. If for business travel, you can do Zoom, I would do it. I think that probably that's quite an intuitive answer. Likewise, so there will be an impact. I think that is why when we say airlines, it's a good trading because it hides a lot of this weak economics. So in the near term, everything is just about China open. So right now, you're only getting the first wave of travel coming back, right? You only have a bit of tourism, a bit of business. Then you get the full tourism. Then, like in Singapore, MICE is only just returning. So, but you are exactly right. If most corporate won't go all the way and travel so far, that has changed. That you can the familiarity. So there's a longer term impact. Yeah, I totally agree that just that near term, everything will look fantastic, but it will shield, it will hide, it will mask the real underlying, like what you said. There is this weakness. And just to sidetrack, I think when we speak to some corporates, ASEAN will actually benefit. And you didn't ask me this question, but just to share what the corporates think is that when China reopens, where is the first business destination they're going to go? It's going to be ASEAN. I don't think other developed countries are so open to them. So I think ASEAN is a big, I think even Malaysia, I think most of you know that there's a lot of Chinese investment. So I can think that when China reopens, travel into ASEAN will be even greater. Because the businessmen, I don't think the first destination, I don't think they're going to go to US or they're going to go UK, it'll be ASEAN. The second thing on office, I can just share on Singapore. There is an impact, but our occupancy in office is almost close back. I think it's about 70%. So actually for Singapore, the phenomena is different. It's almost back to, of course, never 100%, almost back to. And also for Singapore office market, we're also getting a lot of the Chinese tech companies coming in. And supply is very minimal. There's only going to be one big development actually by IOI next year. So office in Singapore, it won't be robust, but it will be stable because there's very little supply. I mean, worse by the pandemic because nobody could build any supply. US is a bit tricky. It depends on where you are. If you're in gateway cities, New York, then a bit of an issue. But if you're on the non-gateway cities, then it's a bit better. So that's why some of the things, just to sidetrack a bit, sorry, like Manulife, one of the things they're going to do is to hotelize the office building, which is basically just putting a carpet. I mean, basically just making it nicer. Hopefully, employees will come back. But in Australia, but in US, it's pretty bad because it's like 30% return. Then if I'm, why do I need so much space? But Singapore not so bad. Singapore is, I think, if I'm not mistaken, to about 70% occupancy. The reason why I hesitate is because this comes from the corporate. And how do they check? They probably just have a scan. So they also tell you we don't have like 100%, like I can't identify. It's not like some CIA that can track your face and everything. So they just tell you anecdotally how they think, and the number's about 70, which is quite a good number to have. And when we track all the transportation stats, because you can use it in Google, travel to office is almost actually quite close to pre-pandemic. So Singapore is not that bad. Yeah. I hope that answers. Yeah.
Hello, can I ask about those commodity company and the resources company listed in Singapore? What is what you're thinking, like Bumi, Dama, the Joe Energy?
Yeah.
What is your analyst idea?
Okay, so for palm oil, we don't cover because we can never beat the Malaysian analyst. So we said we don't cover. We don't even try. So I'm going to comment on palm oil. But for Wilmar, Wilmar will do better because they have such a huge presence in China. They have edible oil, and they're also building a lot of central kitchen, which is a new business they're going in. because in the end, restaurants in China or I guess anywhere in the world right now, they're just going to be mixing and everything, and all the sources, everything will be done centralized. So this is the big game plan for Wilmar, and with China reopening, I think Wilmar, and with swine prices coming up, that will also be a benefit. Coal, there's only one company left in Singapore. There's Geo. I think they will do well. I think what's happening in Europe, and we all know how sustainable energy is. That I think coal can still rally, especially with the reopening of China. So commodities, we think it will. It can still recover, mainly because of China. We're all just looking at that as a recovery. Palm oil, we got no strong view because we don't really cover. But just for the benefit of everyone, for commodities, we only have iron ore, the Malaysian companies, we have palm oil, we have coal. Well, there's only one company because the other one is going for GO takeover. And then, yeah, that's about, and of course, commodity traders like Olam and also, yeah. But generally, I think it should recover, especially Wilmar. Yeah.
Hi. Just now you foresee a soft landing with the US market. So has this soft landing been priced into the US market, and the market has already bottomed out, and so now we are kind of like going forward, it will be kind of an uptrend?
Yeah, I'll just, no, I don't cover yours, but let me just give you so from peak to trough, from peak to trough, I'm talking S&P. S&P is probably down now mid-teens. If you're in a deep recession, it can go down 40–50%. So my own thoughts for the US is just going to just a sideways track, because valuations in the US is not cheap. So you can call a bottom at like 13–14 times PE or higher. And also in the US, what is happening is also the earnings growth is at risk. So the earnings growth could be. So I don't think the US bottom. I think the US will just crack. The bigger worry is, will it collapse? Which we don't think so. But if you're a pessimist, the US will bottom in the middle of a recession. And also the US only bottom after the Fed has cut rates. So if you're the very pessimist, you think deep recession, then the market probably there's another 20% downside, which we don't think so. But historically, there is merit to it, because imagine the Fed is still raising rates. So for the US to bottom historically is when the Fed is actually cutting rates, then the market. So you can think it's like, I don't know how many more months, end of this year. So we're not into that camp, but we can understand the argument of that camp. If you really think there's a deep recession, there's another 20% downside. Yeah, because peak to trough, US market in a deep recession, 40–50%. But if you know, but these are with devaluation events like .com and all that. So we think if you, so if it's not a deep, it's a recession without a devaluation event, probably 30% downside. So which is maybe another 20% downside. So sorry, it is just some rough numbers, and yeah, just a view. Yeah.
So you feel there is another?
Yeah. I don't feel that way. I feel we are just going to. I think US will just bounce up and down, probably a low single digit, because valuations are so high and you don't have earnings momentum. Yeah. And if you lose that, and if people do not like tech, maybe people go to US to buy tech, right? And if you don't have that tech story behind, and because tech, basically all the demand put forward, right, in the pandemic years, I might move to emerging markets. Again, I'm just saying I'm not a global strategist, but if I'm thinking that tech, there's not much growth in tech, even there's growth, the last 2 years, all the demand already went in the pandemic years. So if there's a derating of tech, then emerging markets could do well, better, I mean, because of value, and that could be the better areas of growth. Yeah.
Hi, with the reopening of borders, both in Thailand and in the South Asian market, what are your views on Thai baht being listed in Singapore? It has not moved significantly.
Yeah, we still like Thai baht, mainly because you will still get the reopening benefit, because there's still a few more months year on year. It's very easy because last year shut down, today open. And because there's an election coming up in Thailand, and usually, I mean, no one's going to hide, right? But usually there is some fiscal spending somewhere, and that kind of benefits the consumption of these items, alcohol consumption. I think we all know Thai baht is alcohol. So we think the next 2 quarters they should do well. And there's a bit of a World Cup phenomena. because the World Cup is now in the Asian hours. I can't quantify, I mean, like full drink more than last year, right? I can't quantify, but you get a bit more vibrancy in the near term for the next two quarters for Thai bev. The only worry for us for Thai bev is always the custom duty. I mean, like in Malaysia, then suddenly all of the blue, they just call you up and say, I'm increased my duty on you. Then the share price will come off a bit. It has been delayed, actually. Usually there's I can't remember a year cycle. So we think maybe after the election in Thailand, maybe in May, a bit more wary, a bit more, because we're not sure whether custom duty might be imposed. It's always like, look behind your shoulder kind of thing. But in the near term, I think there's earnings momentum for Thailand, because Thai bev is mainly spirits, rum, and is mainly consumed in the farmers, and the incomes are getting a little bit better with reopening and everything. Yeah, just a general view.
Yeah. From what I know, this or not on, sorry, Olam. Olam will intend to break up into 3 sections, isn't it? Three separate ones. So what do you think? Is it a good move, or is it
I
a
think,
desperate move?
It's a massive company. I can't say desperate, but it's a good move in the sense because I don't have the exact numbers of my fingertip because I didn't have time to go through, but we did a quick reval. So the market roughly of the Olam now is about, I think, 5-6 billion Sing. So for those who don't know, okay, Olam is the Olam group. So they're going to split it into 3. Olam Agri, just bear with me, Olam Agri, Olam Food, and then one, you call it Olam Venture. Let me just go take money, let's go and try all kind of venture. That's where I want to work, because profit not important, right? So Olam Agri, they managed to sell to the Saudis, market cap, again, don't hold me to it, about 4 billion, which is already quite comparable to the group. And they're going to list that. Of course, the thing is that once you list, can they sustain that 4 billion? I'm really not sure. The other part is even bigger than the other part is even bigger than the Olam Agri. So it could be actually 4 to even, it could be 50%. So if you do some rough maths, it could be 4 billion here, maybe another 5 billion, which is much larger than the 6 in the current market cap. So that is very clear. And then you get this ventures free, which is, that's going to make a bet. Then you also have a 4% dividend yield. So even you're not wrong, just wait. So I think, sorry, go ahead.
So it sounds very good, isn't it?
Yeah.
Especially when they get, as you said, the Saudi people to buy.
Yeah, the Saudis are already in.
The Olam Agri.
Yeah. The only unknown is just the middle part, because it's Olam Agri, that one already done. At least someone put in the money and giving me cash. Thanks very much. So I can de-gear. The middle, the timing, nobody knows, because it depends on the London market, how well they do. Nobody can give you an exact valuation for all 3 because we are doing EV EBITDA and we do not know how the debt is parceled out. So that's the caveat. But it will still be bigger than the current. That one is almost done deal. When we did our back of our envelope, because we do a range, and even if we do the low end of the range, it will still be better. So the near-term catalyst is that they're going to list the Olam Agri, the one with the Saudi. So it's where the evaluation is going to stand. Like who come? If I'm a fund manager, why would I buy? I can buy a parent. Why do I need to go through this? So I don't know. But they're going to do a concurrent listing in Saudi Arabia, and it's fungible. So we're just hoping that best case the Saudi valuations can pull the Singapore, because it's fungible. Yeah.
So it's a good bet.
Yeah. It's a good risk reward. Whichever way you look at. The only thing is just your timing. I can't give you the exact time when this will happen.
Hello. I just want to find out which industry is contribute the most income for Singapore government. Is that Malaysia, we have a semiconductor, palm oil, oil and gas. So we just want to find out which industry so that we can zoom in, to find this leader. Rather than we go to the bush, such a bush, to find which company.
We are quite well diversified, I would say. It's a good question. They don't really share the sources. Property sales is important, right? They just reclaim the land and then sell you the sand and then for billions, right? So that's important, but it's quite well, no? I think we have manufacturing, we have transportation and everything. I can't pinpoint one particular. Actually, we are quite well diversified. One major trend for us is wealth management. So that's very important. But you ask me like how much contribute, I really don't know because they don't give that breakdown. It's a good question, maybe because that one is probably like page 246 of their whole document. Maybe I didn't go through that. But you can think of it as quite, because we have manufacturing, like you said, we have banking. That is a big trend for us because of the hinterland here, which on paper, you want to argue we should be even bigger than Switzerland. I mean, on that, for argument's sake, because we got bigger population with India, we have China, right? And then we have transportation, logistics, but they never really give the GST. Yeah. So I wouldn't, like Malaysia, you pinpoint on oil and gas commodities. I wouldn't pinpoint us on that because we also have petrochemical. So we are very well diversified. I think global trade is the best indicator if you want, because our exports to GDP is probably 400%, but we're probably one of the biggest, probably next to Malaysia. So that is probably, global trade will be one of the ways to track directionally. Yeah. But it's very hard, it's very tough because the way they design it is to spread out across. So we don't have a Petronas, I mean, obviously. We have a Temasek that will contribute, but yeah. And yeah. So sorry, I didn't give a good answer for that, but you can just assume it's quite well diversified.
So that means any industry we can pick. So as long as in the trend, so
yeah, but some will be up and down. We made it many, like if you talk of us like Changi is important, the ports are important. So there's also one third. Like every part contributes because we want to be the hub. Yeah. So if you want to track again, you can just say Southeast Asia is the most important for us. Right, because trade in Southeast Asia, wealth management from Southeast Asia. Yeah, so that's the key. Yeah, and if you want to link it to the stocks, is even harder because a lot of it could be electronics, banking. Banking is 40% of the index. So bank is the most important. How you want to track the banks? Just the general economy, including Southeast Asia. So it's hard to isolate one Petronas equivalent or oil and gas. Yeah.
Okay, thank you.
Yeah.
Hi. What's the view on the commodity, example, the hard commodity, like silver, gold, aluminum? Because the silver and gold, the ratio getting closer, and maybe due to the interest rate or the recession fear. Thank you.
Yeah. I'm not an expert in silver because it's industrial commodity, right? I also do not know the demand supply dynamics. Whenever investors do ask us about gold, the only advice we always gave was that firstly, for gold, you're just playing the flows. So which we thought wrongly because gold didn't do that well. We thought that when there's a bond rout, that means when bonds were collapsing, investors might move to gold just to hedge out. But they did a little bit, but it didn't. So this time around, if you take the view that the interest rates are coming down, then I think gold can rally, but it will be just a short-term flow-driven rally. And I guess you can just put gold, little bit of gold portfolio if you think there's some big event. Because if there's the only time gold moves was when there's a Ukraine war. After that, we just didn't do anything. So it's more like you just buy it's like an event-driven kind of commodity in the end. Because if I put money in gold, I'm losing like 4% opportunity cost. Yeah. So for me, gold is going to be just, it will be flattish. Then if there's an outbreak of some war, hopefully not, but then you're the only guy who make money is the gold guy. So it's like a hedge. Because if you look at the charts, only when Ukraine war there, or then things shot up, then after it just dwindle, just went down. So it's more like a deflationary event kind of commodity. Because right now you got 4% interest rate, people would rather just put the money in cash and deposits. Yeah.
Thank you.
Yeah, no problem.
I have a question. This one is it's not specific, it's general.
Yeah.
Some people say that there's a lot because China is tightening on Hong Kong. There seem to be a lot of movement, business or things from Hong Kong to Singapore. Do you think this will be a very significant move? For example, especially in investment, I see a lot now, they call it about private office.
Yeah, family office. Yeah.
Private office in Singapore. So you think that Singapore will be getting more and more important compared to Hong Kong?
Yeah.
What's your view?
Yeah, I think it, not nice to say, but it probably helped. I mean, inverted comma. If you ask any lawyer in Singapore that does family office, they can tell you there's a lot of family office, especially in China. Of course, the part two of the question, if you ask them, if they want to tell you, is whether when they put the money in Singapore, does it stay in Singapore? I'm not sure. Our reserves did very well, so there is that flow. There was a people flow, of course. That's why I think our rent in Singapore is at all-time high. You probably, if you want to get rent anything in Singapore, you probably have to waiting list. You won't have to when you. I'm totally sidetracking, but if you like Singapore, you want to rent any place, you want to come and visit a place in Singapore to rent, they ask you for deposit first because it's so. But there is a flow. There is people that have come out from Hong Kong. Anecdotally, Singapore will never tell you the stats. Even though they know it, but there is definitely some flows. The final is that we hope there could be some listings that come into Singapore. Some of these big Chinese companies that want to list here, not their China assets, but at least their assets outside of China. So that could help our market a little bit since there's hardly any IPOs. But there is, yeah. There's flows and also there's people coming. Yeah.
You referred to ComfortDelGro. Why is it doing so well in Singapore and not in Indonesia and Thailand?
ComfortDelGro is mainly in Singapore. No, Indonesia, Thailand, they don't have much, but they're doing well. Just the whole rebound. So Comfort did well because of the rail. Because the rail traffic bounced back very strongly. A lot of people go back to office, no choice, and also there's an increase in prices. Secondly, the taxi, they were giving a lot of rebates during the downturn, and then now they're giving less. And they also shifted their taxi, because taxi is the best business to own, right? I just ran, no passenger, that's not my problem. But they cannot continue with this model anymore. So they had to give a bit of rebates and they have to share the risk with the taxi driver. So they'll take like what Grab does, they'll share the comms. So that's why they're doing well. Overseas didn't do well because they're spending, and there's a lot of issues a bit on buses in the UK. Yeah. Yeah.
Okay, thank you.
No problem.
Okay, I've got a question about, I know this is highly unlikely, maybe in your head. In the event of a US dollar crash, what would actually happen to the Sing dollar and maybe Malaysian ringgit?
Okay, I can't remember the correlation. I wouldn't say we're very correlated to the. Last year we were. The thing is, why it crashed, I guess this is probably the main reason. So I don't know, maybe Sing dollar would do well because there's not many safe havens. Sing dollar is considered a safe haven. You probably notice our foreign reserves dropped, but actually a lot of it was transferred out. So I think we could be considered a safe haven, and that might help us. But again, depend what is the rationale. If there's some event in Taiwan, I'm not sure. Yeah.
Because of decoupling, and maybe events like that, geopolitical.
Yeah. Singapore generally viewed as a financial hub, as safe haven.
But you're so back to the US dollar.
No.
So
we're not. What we do is we are hedged against a basket of currencies because they never tell you. But I think probably US is probably the Chinese yuan RMB is probably in the basket. So is who we trade with. That is the way that is the way they peg.
So you think in the unlikely event, Singapore dollar should hold steady and
yeah.
So would the ringgit, I guess.
Because
we are a commodities country.
Yeah. Depend what is the commodities. You can't really say because US is such a big oil exporter. So in a way, US is also seen as an all beneficiary of oil prices. So if the oil go up, actually, one of the reasons US dollar went up because of course the interest rates, right? And also because it's considered is a commodity. It's a commodity foreign exchange now. They're the big one of the probably the second big 12 million barrels per oil Is it 12 million? Yeah, I can't remember, but they're one of the biggest, maybe not the exporter, but one of the biggest producers of oil. Yeah, so they're already considered a commodity currency. Yeah.
Are you more optimistic about Emperador or Thai Bev?
I think longer term, Emperador has a better story. Although the valuation is 20, 30 times. For those who do not know, Emperador is actually a dual listing into Singapore. Emperador is Del Mar whiskey, so they sell single malt whiskey and also brandy in Philippines. Why is a better story longer term is because their whiskey is on allocation. I want to, again, it's another department I want to work in because it's all sold out. Because you need barrel, because your barrels are 20 years ago and they price around 15-20% easily or not more. So I think they could even raise their product price 40-50%, and even then they'll still be on allocation. What Emperador has done well is they penetrated into China, and there's no price elasticity there. And with China reopening, the price. So the best business is like owning an LV, just raise price. Yeah, of course, this one can drink, but
what's going on with YZJ? They seem to be, yeah.
They the financial or the shipbuilding or
well, I've got a question for the financial later,
sure.
but right now the shipbuilder first. The shipbuilder, I mean, they've been going down for the past week quite a lot. Maybe because of one of their subsidiary have been like, I mean, one of the creditors are.
Yeah, just for benefit. So just in case everyone. So Yangtze Shipbuilding is a yacht in China. They make container ships, and of course, container did so well, right? So every day they probably I'm just exaggerating. They probably get a phone call every day to just build container because container rates that you saw on the chart went up so high. What took the share price very well that you guys might have, audience might have seen is because they managed to penetrate LNG. Or not penetrate, they did a technical arrangement, so they should be getting one big LNG contract. My own view of, if you look at their order book, right, Yangtze Shipbuilding order book didn't really grow that much. It's only like mid-teens year on year. If you do third quarter, this year, third quarter, the hype is about LNG because LNG is the hottest, right? So I'm a bit more wary of, because container rates, is coming down. So like most of their orders are all container, that's gone. Dry bulk ship rates are still not moving, so the dry bulk fee is not going to do. So it probably, once they get the big order from LNG, everyone's going to sell it down. I don't know. Okay, that could be the thing. So I'm a bit more cautious on Yangtze Shipbuilding because this is all about just that one big LNG. Because they do LNG, but it's all small. So now everyone is just pressing the sell button. I don't know. I'm just kidding here. Everyone's pressing sell button once they get the big LNG contract. The story might be over because container is coming down. Because container, right, the rates it's just collapsed, so you can assume no orders for container. And this story is all about order book. Nobody wait for your results. It's too late. Yeah.
As for their financial, what's the prospects?
Yeah, financials. Like I said earlier, you want to buy China. No, okay. So Yangtze financial story for you. Yangtze Financial is part of Yangtze Shipbuilding. So it's very weird, right? You have a yacht and a hedge or a money lender. Actually, they are. So when the downturn came, Yangtze Shipbuilding took a lot of the cash and then lend money in China, which is through a bank too. Okay, so then they stripped the business out and listed separately. So earnings in Yangtze Financial, we think in the next 2 years, it's just going to go down. It's like almost a done deal because they're shifting their assets from China. The money that they lend, about 2 billion, they're going to bring it to Singapore. To go into PE, the revenue PE is not going to, it's probably zero negative, then probably take you 2 years, you're lucky to go up. And to replace what you lost in China, it's just going to go down maybe 2 or 3 years because PE, you probably, after 3-4 years, you can sell the asset and get the carry. So that is one part, earnings coming down. Second part is their price book is cheap, 0.4. About Chinese bank is 0.5. So if I'm an investor, I want to buy Chinese financial, like I don't want to go buy Yangtze, I buy the banks, come all the way or go through Singapore, just look for one stock to buy Chinese financial, forget it, I'll just buy the Chinese banks. This is my own view, of course, I'm not the analyst, but that will be the challenge they have. If I go and talk to my client, buy this because they are China, I say, why? I best buy Hong Kong, then the phone will hang on me, because nobody will buy. Yeah, so that's my worry for Yangtze. The earnings down, and then technically it's cheap, but the Chinese banks are paying, I think, 9-10%. I can't remember the rate now, but they're easily 0.5 times book, 9% 9% yield, and these are Chinese state-owned banks.
You seem to be very pro US-based REITs. One of them is in your recommendation. My personal view of that is I think it's quite risky because I think the US dollar itself is overpriced. It's on its way down. Again, my personal view. The second thing is that what's your view on because their market cap has taken a big beating recently and discount, and with their current gearing, the gearing would actually rise maybe in relation to that. So they might be forced to pare down their gearing. That's why it's going to reach that. So wouldn't that depress the price prospects of US-based REITs in Singapore?
The market cap won't affect the gearing. It's mainly the assets, like you said. But the gearing did come down mainly for that one company which is bordering on. So this one, like I said, Manulife. If you talk about US REITs, they are the biggest. They're the ones. So they got hit badly by one particular asset, and then their gearing come close to 50%. So for Singapore, I won't bore you there's an ICR, but once they cannot cross 50. Once they cross 50, it doesn't mean you're going to get delisted or whatever, but what it means you cannot borrow anymore. You're going to try to fix it. They'll give you time to fix it. I'm not that worried. I think early Feb and Prime releases the results. That would maybe convince the market that the devaluation won't be so bad. The other catalyst that might happen is Manulife is they got strategy review. Basically want to sell something. So if they can sell an asset, maybe even if it's a 20% discount, I'm not sure. There's not a bit tricky. I'm not sure how the market will view it. Will the market view it positively or not? Because you're trading at 0.5 times book, but I still managed to sell. But of course, they send an argument of maybe the rest of your assets. So it's a bit tricky, but it could help them de-gear and it could become a catalyst for the stock. But again, I just think that it's just too pessimistic. I'm not saying the US REITs are like having a fun time, but I'm saying is that the way it's been priced is just a bit too much. And for real estate, you can get a better price. If you're doing PE, your PE, everyone's PE is up to your subjective. But you're talking about real estate, there's a bit more transparency, good or bad, because then your upside is also limited, right? But it just gives more clarity to the valuations. Yeah. I hope that helps. I'm not sure.
Thank you.
Thanks, Paul. Due to time limitation, we will only open up one more questions. The gentleman over there.
Hello, sir. My question in relation to the family office. I watched a video produced by the, I think, business station of the Taiwan, talk about a lot of money from China. Instead of Hong Kong, they moved to Singapore family office. Just to check with you, based on your local knowledge, is the money who really moved to Singapore start moving to buy the Singapore domestic asset, whether it's property or invest in the business, or they just register office, family office in Singapore, but all the money, all the assets still in example like China, Hong Kong, or overseas. It's just by name they are there, but the money is not there. Maybe you can share with us, or maybe how much the actual status, whether physical or the money flow into the financial market like bond, treasury, or share market. Thank you.
Very hard for me to answer, but I'll just tell you it's later. I can't be too specific, but it's a bit more on the later part. Yeah, we don't think the assets will stay or even filter into the Singapore assets. We don't think so. I mean, maybe they might buy a bit of property, maybe buy a few luxury cars here and there. I don't think my own view, I think it's more the later. I don't think most of the assets will be part for Singapore and invest in Singapore. Yeah, I doubt it. Yeah.
Sorry, Paul, we have actually two last questions from online. The first question would be what you think about the tech sector. The second question would be, can you comment on electrical cars?
Oh, okay, I don't know how to comment on the second, but actually for the tech sector, we still think it's a down cycle in general. but you won't see the earnings declining that badly. The reason why I hesitate is because most of the semiconductor companies in Singapore have secured new customers. Because what has happened is that during this upcycle, a lot of them have either found new customers or have also they'll find new customers or they have got new products from their customers. So even though the Singapore semicon might come down, but it will not drop as much as the rest because the supply chain they're getting more opportunities in a supply chain. Some of them, number one, have new customers. Number two, with the existing customers, they are probably entrenching themselves more in Southeast Asia. I mean, this is what I can share. But in terms of the sentiment-wise, I think probably only end of this year, maybe third quarter of this year, the overall semiconductor. There is if you ask any if you know any friends semiconductor, they just tell you it's a downturn now. For EV cars, I don't have a real strong views because there isn't really many listed Singapore companies. There is a dual listing by NIO. That's why it's very hard for me to comment. Yeah. I can comment, probably the wrong comment, so no point. Yeah. Thanks.
All right, thank you, Paul. Thank you so much for your participation. Now that you are well equipped with the Singapore market outlook, we actually have a Malaysian market outlook coming up on the 4th of February, conducted by M Investment Bank ourselves, our in-house research team. That will be a webinar happening from 10 a.m. to 11 a.m. More information will be sent out to you closer to the date. So I wouldn't want to hold up longer. But then, may I please invite all of you to be on stage for a group photo before we go off? Please, together with the two speakers, Benny.